Hello everyone, welcome to EduTap and welcome to the most important session of the Finance 360-degree series. So the Reserve Bank of India has launched the annual report for the financial year 2024-25 and this is the most important report of the Reserve Bank of India. And in today's session, we are going to have the detailed discussion on the data points on the points that are given in the annual report of the Reserve Bank of India. Okay, so there are more than 300 pages that are in this report, but do not worry about it. I am here for you, and I have, in my 2.5 days that I broke down the whole report and I brought the most important points for you all. So in today's session, we will have the detailed discussion, and in this session you will get the most important points from this annual report of 2024-25 and you will get the understanding of very important points also. So give me a thumbs up if I am clearly audible and visible. And let me tell you that this report is very important from the examination perspective. In the previous years there were objective questions, there were questions from this annual report, okay, and there is the chances for the descriptive question from this report also, and there are various data points that you can write in your answers, okay. So all of that we are going to discuss in today's session. So let's get started, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is in the description box below, okay. So we are going to start with the session, and this is one of the most important session of the Finance 360, okay, that you have to focus on. So RBI has released the annual report for the financial year 2024-25 that covers the working and functions of the Reserve Bank of India for the period of April 2024 to March 2025, okay, and this report, it is released on the yearly basis. Now basically the report is divided into two parts. The part 1, the economy review and prospects, and the part 2, that is the working and operations of the Reserve Bank of India. So in the part 1, we will understand about the situation in the global economy, the growth, the inflation situation in the global economy, and then we will discuss about the growth and inflation situation in the domestic economy, as well as the employment situation, the situation of the trade and such. So all these important things we are going to discuss in the first chapter. In the second chapter, we will discuss about the important steps that the RBI has taken in different segments, in different domains, okay. So let's start with the first chapter or the first part of the annual report, that is your economy and prospects. So first we are going to start with the assessment and the prospects for the global economy, So as per the International Monetary Fund, in April 2025, it released the World Economic Outlook, and as per the World Economic Output, it was projected. So as per the World Economic Outlook, it was projected that the economic growth or the global growth for the 2024, it was projected at 3.3%. So according to IMF, the global growth was projected at 3.3% in 2024. That is lower than the economic growth or global growth of 2023, that was 3.5% in the 2023, okay. So you can see that the global growth has reduced from 3.5% in 2023 to 3.3% in 2024, and this global growth that is projected for 2024, this is way lower than the average of 3.7% that was achieved in the period of 2000 to 2019. Now, why the global growth is going down, or why the global growth is projected at a lower pace in 2024? This is because of the structural challenges that the world is facing at this point of time, like the weak investment. If I will show you the data points for India also, and you will see that the foreign investment has reduced drastically in our country. Slow productivity, growth, and high debt levels. The advanced economies, the major advanced economies, and some of the emerging market economies also, they are under the high debt levels, and this is becoming a new problem in today's era, okay. Now for the future also, you will see that for 2025, the IMF has projected even lower growth, that is at 2.8%. So global growth is projected to further decrease to 2.8% in 2025. So this is a problematic situation, and why is it so? So global economic outlook for the 2025 and 2026 remains clouded by multiple challenges. Multiple challenges can come in the 2025 and 2026. So the challenges are, first of all, the pace of disinflation might lose momentum. So right now, the inflation at the global level, the inflation is at nearly 5.7%. in 2024. So that is a quite high percentage. So the inflation rate at the global level, it was 5.7% in 2024. So you can see that this inflation percentage is quite high, and it is expected that in the coming months, in the coming period, the inflation rate is going to decrease. The inflation rate is going to decrease. That means there is disinflation that is going to come at the global level. But what if this disinflation momentum starts losing, or what if the disinflation do not happens? So then it will create problem at the global level. So the global economic outlook for 2025 and 26 is clouded by multiple challenges. First of all, that what if the pace of disinflation lose momentum? What if disinflation do not happen properly? The inflation rate do not decrease much. Elevated public debt across several economies, advanced economies, the major economies, the many of the emerging market economies also, they are under a huge public debt. Okay. Protracted geopolitical tensions. So the geopolitical tensions are stretching. You can understand that Russia-Ukraine war, it started way back, and still there are certain like geopolitical tensions that are going on. There is heightened trade tensions with the tariff war that was going on, with the protectionism that was implemented by many countries. So there was heightened trade tensions, as well as financial market volatility and climate shock. So all of these are clouding the outlook for the global growth. Okay, and that's why the IMF has projected that the global growth is further going to decrease in 2025 at 2.8%. Okay, so this is the idea. So we have understood about the growth. Now coming to the inflation. So global inflation eased at 5.7% in 2024 from 6.6% in 2023. So you can understand that from 2023 to 2024, there is the decline that has come in the inflation rate, but still the inflation rate is at 5.7%. So this is a problematic situation because still the inflation is higher. This is reflecting. Now, first of all, how the decrease happened in the inflation rate from 6.6% to 5.7%. So this was because of the monetary tightening that was done by the major monetary authorities around the globe. So around the globe, the monetary authorities, they did the monetary tightening, or they increased the interest rate in their economies. When the interest rate is increased, you can understand that at higher interest rate, there will be less loans that will be taken. Less loans means less demand, and less demand means less prices, and so the general price level starts getting controlled. Okay, as well as the easing of supply chain constraints. So supply chain pressures also eased. Due to this, the inflation rate started to decrease. We can say the inflation rate started to decrease. So here you can see that inflation rate, it started to decrease from 6.6% to 5.7%, but it is still high, but it is still above the pre-pandemic levels, largely driven by persistent price pressure that is coming from the service sector. Okay, so the inflation rate has decreased from 2023 to 2024, but still the inflation rate at 5.7% is higher than the pre-pandemic level. So that is a problematic situation, and that's why disinflation is required. That's why we want further decrease in inflation rate. So disinflation means that decrease in inflation rate we want. Okay, so global inflation is expected to moderate from 5.7% in 2024 to 4.3% in 2025 and further 3.6% in 2026. So this is projected that inflation rate is going to decrease at the global level. Okay, so that is a good news that the inflation rate is going to decrease at the global level. But if any problem comes in this decrease, that will create problem for the global economic growth also. Okay, now global merchandise trade volume. So global goods trade volume, this has expanded. So this has increased by 2.9% in 2024 after decreasing by 1% in 2023 with easing of supply chain pressures. So as the supply chain constraints reduced, so the goods trade expanded at the global level by 2.9%. This is as per the Global Trade Outlook and Statistics update of the WTO. Now, global merchandise trade, this is for the 2024. This is the data for 2024. For 2025, it is expected that the global goods trade volume is going to contract by 0.2%. So that is the global goods trade volume. This is projected to contract. This is projected to decrease by 0.2% in 2025 under the adjusted scenario based on the tariff situation that is going on, the trade war kind of situation that is going on, and the tariffs that are being imposed by the different countries. Okay, so due to that, it is expected that the global goods trade volume is going to contract by 0.2%. However, the signing of the trade deals between the US and UK and the trade deals that are signed, or the agreement that is made between the US and China, so this present a better picture for the global trade. Okay, so due to the trade war, or due to the tariffs that are being imposed, it is expected that the global goods trade volume is going to decrease by 0.2% in 2025. But the agreements that are being signed between the countries and the trade agreements or the trade deals that are happening between US and UK, so this is giving a better position for the trade, for the global trade. Okay, now here you can see that global trade flows continue to be confronted by geo-economic fragmentation. So the global trade flows, the trade that is happening between the countries, this is confronted by the geo-economic fragmentation, the fragmentation of the countries, the division that is coming between the countries, and the geopolitical tensions that are coming up, and restrictive trade policies. So because of these two reasons, the global trade flows continue to be confronted, and that's why it is expected that the global goods trade volume is going to contract by 0.2% in 2025. Services trade has exhibited resilience, and there is continued recovery in the travel that is happening between the countries. So after the pandemic, the traveling, or the like going from one country to another country, this has increased again, and so this has recovered. So the travel between the countries has recovered, due to which the service sector and the hotel industry, the restaurant industry, or the traveling industry, it is again like going up. Okay, so there is recovery in the spending on travel, as well as there is demand for digitally delivered services. So service still is showing better picture. Okay, and if you see the global goods and services trade volume, so till now we were talking about goods, but if you see the global goods and services trade volume growth, this recovered to 3.8% in 2024 from 1% in 2023. That is supported because of the strong services trade growth that is happening at the global level. This is as per the World Economic Outlook of the International Monetary Fund. Okay, so the merchandise trade is expected to contract in 2025. So this is the trade data. Now coming to the next point, that is, so now we are going to the next point. So here you can see that US dollar remained firm through the year. So US dollar, it has remained firm. It has continued to increase or continue to be high level, putting downward pressure on other advanced economies and emerging market economies currencies. You can understand that recently there was a lot of depreciation that came in rupees against the dollars. That means rupees was weakening against the dollars. This was not only happening in India, this was happening around the globe. In the US dollar remained firm throughout the year, and this put the downward pressure, this put the weakening pressure on the advanced economy and emerging market economies currencies. Okay, next is Brazil assumed the G20 presidency from India for 2023-24. So G20, that is the group of 20. This the Brazil took the presidency from India, forming a historic troika of 3 nations. So see, in the G20 we have a troika. Troika means 3 countries. One that held the presidency previously, one that holds the presidency currently, and one that will hold the presidency in the future. So India held the presidency until 30th November 2023. After that, Brazil took over the presidency, and after the Brazil, the South Africa is going to take over the presidency of the G20. So this is the historic troika, we can say. So the 3 nations from the global south under the overarching theme. So Brazil took the G20 presidency from India, and the theme of the G20 under the Brazil presidency was building a just world and a sustainable planet. Okay, so this was the theme under the Brazil presidency. So Brazil's presidency prioritized the 3 key areas: combating the hunger, poverty and inequality. So fighting against the hunger, poverty and inequality, advancing the 3 dimensions of sustainable development, that is the economic sustainability, social sustainability and the environmental sustainability. Reforming the global governance structures and making the global governance structures better. Okay, next is pandemic induced fiscal policy measures. See, during the pandemic, the vaccines were required, the masks were required, various things were required. So the government increased its expenditure at the global level, the governments of the different countries increased their expenditure because they had to provide the healthcare, they had to provide the different vaccines and such. So there was the pandemic-induced fiscal policy measures that were undertaken where the government, fiscal policy means where the government increased its expenditure to help the citizens of the country. Okay. Now, what was happening that after the pandemic, slowly the fiscal consolidation means this is the government policy where the government is trying to decrease the deficit and the government is trying to decrease its debt. Okay, so that is fiscal consolidation. Now you can understand that during the COVID-19 situation, the government at around the world had to increase their expenditure and the lockdowns were happening, due to which the tax collection was quite low. So this created deficit for various countries. This created huge deficit or higher deficits for various countries as the government was spending way more as compared to the tax collection or as compared to the receipts of the government. So government was spending more. This created the deficit for the countries, for the governments. Now the deficit was quite high during the pandemic level. Now what is happening? Now the governments are decreasing their deficit, but the deficit that they are decreasing is a very slow process, or they are decreasing their deficit in a very slow manner. This is exerting upward pressure on the global public debt to GDP ratio. So what is happening that during the COVID, they increased their expenditure by a huge level and the receipts were lower. Due to this created a huge deficit. This created a huge deficit for the countries at around the globe. Now, what is happening that the countries after the COVID, they started decreasing their deficit, they started decreasing their expenditure, but the expenditure is still very high. They are decreasing the expenditure, but expenditure of the government is still very high, due to which the deficit is reducing, but it is not reducing by a good manner. Okay, the fiscal deficit or the deficit is reducing, but it is still quite high. So you can understand that deficit is still quite high, and to pay for that extra expenditure, the government is borrowing at different governments at the global level, they are borrowing, and this is exerting upward pressure on the global public debt to GDP ratio. So debt to GDP ratio, it is increasing. The debt to GDP ratio, it is increasing for the countries, which is expected to approach 100% by 2030. So this is a very bad situation. This is a very poor situation where the debt to GDP ratio is going to approach 100% by 2030. So this is the idea. Now the fiscal consolidation or the deficit should decrease by a huge level. And there should be fast fiscal consolidation that the government should adopt, because the COVID has finished. Now they can reduce their government expenditure. But the countries, they are not reducing their government expenditure to a good level. And the fiscal consolidation, the decrease in deficit and the decrease in debt is a very slow process. They are very slowly doing it. Okay. So this is a problematic situation. Now coming to the next part. Now coming to the domestic economy. So we have discussed about the assessment and prospects for the global economy. Now coming to the domestic economy. So against the backdrop of a steady global growth amidst multiple headwinds, so there were multiple problems that were coming up, but the Indian economy remained resilient during the 2024-25, supported by the robust macroeconomic fundamentals that we have. We have good savings in our country, we have good consumption demand in our country, we have good investment levels in our country. So proactive policy measures were taken by the government and sustained government capital expenditure. So government is doing the capital expenditure that is very much required for the country. Capital expenditure means expenditure on the assets, expenditure on the road, expenditure on the infrastructure for the country. Okay. So the government is doing the sustained capital expenditure. Now, although the real GDP growth has moderated, very important data point. So the real GDP growth has decreased to 6.5% in 2024-25 as compared with the 9.2% in 2023-24. So you can understand that the real GDP growth is good in 2024-25, but it is still very lower than the real GDP growth of 2023-24. So India, now the real GDP growth has decreased, or the real GDP growth has moderated to 6.5% in 2024-25, but still India remained the fastest growing major economy. And this growth that we have achieved of 6.5%, this was because of the improvement in consumption, demand and net exports on the expenditure side. So the net exports, now the exports consist of goods and services. Okay, the exports consist of goods and services. So in our country, the service exports were quite high, and that's why the if the service exports are quite high, if the consumption demand is quite high, so that helped in the growth of the country. Okay, so here you can see, so total consumption expenditure, this has increased. The total consumption percentages here, this percentages you do not have to remember, you just have to remember these percentages of 6.5% and 9.2%. Just remember that the total consumption expenditure has increased in our country, as well as the net exports, the exports, that also increased. The export or the net exports in our country increased because of the service sector, okay, because in our country the service sector is very, very strong. So here you can understand that economic activity in our country was supported by the improvement in consumption demand in our country and the net exports on the expenditure side, and buoyant services sector, the strong services sector, and recovery in agricultural production on the supply side. Okay, so this is for the supply side, the agricultural production was good. Now all the references to the GDP data is as per the second advanced estimates that were released in February 2025 by the National Statistical Office. This is from where the data has been taken. Now next is aggregate supply. So this was the demand side. This was the demand side, that the real GDP growth has moderated to 6.5% from 9.2%. So this was for the real GDP. This was for the real GDP. Now we will see for the GVA, that is gross value addition, that is from the supply side. Okay, so aggregate supply measured by real gross value added at basic prices. So aggregate supply or the total supply, the total production that is happening in the country, that is calculated at GVA at the basic prices. GVA at the basic prices. So this has expanded, this has increased by 6.4% in 2024-25 as compared with 8.6% a year ago. So you can see that the GVA at basic price has grown by 6.4%, but this growth is lower than the growth that we have achieved in the 2023-24. So growth in GVA in the agriculture and allied sector, you can see that agriculture and allied sector, this sector was able to grow faster, and this sector was showing resilience. So here you can see that agriculture and allied sector, this has seen a good growth, and due to the good growth in the agriculture sector, India was able to grow in the financial year 2024-25. So agriculture and allied sector in 2024-25 stood at 4.6% as compared with 2.7% a year ago, driven by the record food grains production, aided by adequate reservoir levels and favorable weather conditions. So agricultural growth in our country was quite good. Okay, and due to that, the growth can happen in the country with the help of the service sector also. So growth in industrial sector moderated. Now the industrial sector, the growth has decreased, the growth has moderated from 11.0% to 4.3%. So industrial sector was a little problematic in our country. So growth in industrial sector has moderated. The growth has happened. The growth has happened by 4.3%, but this growth rate is lower than the growth rate that we achieved in the past year. Okay. Now the growth rate has moderated because of deceleration in manufacturing. In the manufacturing, the deceleration has happened. The decrease. Here you can see in the manufacturing sector. The manufacturing sector has grown by 2.8% as compared to 3.2%. Okay. Now again, here the percentages you don't have to remember, but remember that agriculture sector showed resilience and agriculture sector grew more as compared to the previous year, while the industry sector, the growth moderated, the growth rate decreased. Now service sector in the GVA, in the gross value addition, in the total value addition or the total production that is happening in the country, the highest chunk or the highest share of the GVA of the production goes to the service sector. So the biggest part of the production goes to the service sector. So service sector has a share of 64.1% in the total GVA of our country. So in the total production of our country, 64.1% is the contribution of the service sector, and the rest of the contribution is from the agriculture and the industry combined. Okay. Now this remained service sector. This remained the main powerhouse of the growth in our country. So this remained the mainstay of the aggregate supply with a growth of 7.5% in 2024-25. So the growth that has happened in the production, this was basically because of the service sector and the increase in the growth of the agriculture sector. So agriculture sector and service sector combined, they have boosted the production in our country. Though service sector, it has more share in the GVA of our country. Now, despite moderation, construction activity So despite the moderation, the construction activity, despite the moderation, the construction activity remained resilient with its share reaching the highest level since 2012-2013. Okay, so here just remember the main data point of the gross value added at the basic price, that the gross value added at the basic price has decreased from the growth of 8.6% to the growth of 6.4%. The growth is happening because there is increase in the agriculture sector. There is increase in the growth in agriculture sector, and the service sector has also remained buoyant, and the service sector has also remained buoyant. Okay, now coming to the next part, that is despite uncertainty around globally coordinated action against climate change, India remained focused on its actions for the climate change, for mitigating the climate change, for reducing the effects of the climate change, and for adapting for the climate change. So India remained focused on its mitigation and adaptation measures. This is also reflected in the Climate Change Performance Index that is for 2025, which ranked India among the top 10 high performance for the 6th year in a row since 2020. So if any question comes on climate change, this is a data point that you can use in your answer, a very good data point. Okay, so India remained among the top 10 high performance for the 6th year in a row since 2020. Now the CCPI uses a standardized framework to compare the climate performance of 63 countries and the European Union, which together account for 90% of the global greenhouse gases emissions. Okay, the climate mitigation performance is assessed. So how it is seen that which country is performing good, which country is performing bad. So the climate mitigation performance, this is assessed in 4 categories: the greenhouse gas emissions, renewable energy projects, energy use, and the climate policy of the country. So these are the 4 measures according to which the country is assessed for the climate change. Now inflation, now coming to the inflation part. So we have seen the GDP data for the Indian economy, we have seen the GVA data for the Indian economy. Now coming to the next part, that is the inflation data for Indian economy. Now if you have seen the monetary policy statements for the past year, you must have realized that the inflation in our country has decreased. Okay, and it has come to the level that we want, that the RBI wants. So the inflation, now till now any confusion anyone has? Because now we are going to start with the inflation. So inflation, any confusion related to the report here? Clear all the points? Okay, so inflation converged closer towards the target. So the target in India for inflation, in our country, the target is 4% plus minus 2%. So the range is lower tolerance level of 2% and the upper tolerance level of 6%. So inflation should not go above 6%, inflation should not go below 2%, inflation should be around 4% within the range of 2% to 6%. So the inflation has converged, has come closer to 4%. Okay, so inflation has converged closer towards the target during the 2024-25, helped by easing input cost pressure. So input cost have reduced, or the pressure in the input cost have reduced. Proactive supply management measures taken by the government, as well as continuing transmission of past monetary policy actions. So in the past, till January 2025, the RBI had increased the repo rate by 6.5% and RBI was keeping the repo rate at 6.5%. Okay. So from May 2022, the RBI started increasing the repo rate, and the RBI kept the repo rate high till January 2025 at 6.5%. Okay. And this increase in repo rate, I have told you that if repo rate is increased, basically this is the rate according to which the interest rate is affected in the country. So if repo rate increased from May 2022, if the repo rate increased, so interest rate in the economy also increased. With higher interest rate, less loans are taken usually. Less loans means less demand, so prices are controlled. Okay, so the prices were controlled in our country because of the monetary policy actions and the monetary policy transmission in the economy. Okay, now coming to the next point. So let's see the data point for the inflation in our country. So now headline inflation, the retail inflation, headline inflation, CPI inflation, all of these are the same things. So the headline inflation moderated to an average of 4.6% during 2024-25. So this is closer to the 4%, okay, as compared to 5.4% in the previous year. So the inflation has decreased from 5.6% to 5.4% to 4.6%, largely driven by moderation in core inflation. Now, core inflation is your CPI inflation. The core inflation, this is your consumer price index inflation. This is the inflation that affects the consumers, excluding food and fuel prices, that are the volatile prices, okay? So core inflation is your CPI inflation. It is the consumer price index inflation, excluding the volatile prices, excluding the food and fuel prices. So that is core inflation. So the inflation has decreased from 5.4% to 4.6% in our country because of the moderation, because of the decrease in the core inflation from 4.3% to 3.5%. So core inflation decreased to 3.5%. As well as there was deflation. As well as deflation means when the prices are decreasing. When the prices are decreasing. So there is a slight difference between the disinflation. Disinflation is when the inflation is present, the inflation is positive, but it is decreasing. So that is disinflation. Deflation, this is the situation when the inflation is negative. Inflation rate is negative when the prices are decreasing in a huge manner, okay? So this is the idea. So disinflation is when the inflation rate is decreasing, but it is positive. Deflation means inflation rate is negative, okay? So deflation in fuel happened at 2.5%. So actually the inflation rate, the headline inflation in our country decreased because of the moderation in core inflation and the deflation in fuel prices. Now the moderation in core inflation was broad-based, and the moderation or the decrease that came in core inflation, this was because of the decrease in prices for goods and services. The uptick. Now what happened that in the second half of the year, in the second half of the financial year of 2024-25, actually the core inflation started to slightly increase because of the increase in international gold prices. You know that how high the gold prices right now are. So as the gold prices are increasing in the second half of the 2024-25, so core inflation also started to increase slightly. But overall, if we see for the full financial year of 2024-25, for this complete financial year, the core inflation decreased from 4.3% to 3.5%, okay? Now there was a upward revision. Now what happened? You all do the recharge in your mobile phone. You must have seen the news also that the mobile charges by the private telecom providers, they were increased. This also affected the service inflation, okay? So there was upward revision in the mobile charges by private telecom service providers. This also pushed up the service inflation. But the good news is that the deflation, in the fuel prices, there was deflation that was coming up. So deflation in fuel was driven by reduction in LPG and kerosene prices on the back of softer global energy prices. So at the global level, there was softer energy prices, due to which deflation in fuel came in India, okay? Now coming to the next point. So here you can see that the inflation rate, headline inflation, retail inflation or the CPI inflation rate decreased from 5.4% in 2023-24 to 4.6% in 2024-25. The majority of the inflation was contributed by food and beverages. So food and beverages in 2024-25, 68% of the contribution that came in headline inflation that came from food and beverages. So food and beverages, the prices or the inflation, there was huge inflation in the food and beverages segment, and that affected the headline inflation, okay? So food inflation remained elevated at 6.7% in 2024-25. So you can see that even though the core inflation, that is the CPI inflation excluding food and fuel, so this was decreasing. There was deflation that was coming in the fuel prices, but because the food inflation remained elevated at 6.7%, so there was 4.6% of the headline inflation that happened, okay? Or 68% of contribution in the headline inflation was from food inflation. Majority of the effect was from the food inflation. So food inflation remained elevated at 6.7% in 2024-25 with intermittent spikes. So what was happening, that food inflation, like suddenly it was increasing very much. If you see that in October 2024, the food inflation was at its peak of 9.7% in the year. Okay, So there was intermittent spikes that were coming in the inflation rate due to overlapping supply shocks emanating from weather anomalies. So weather problems were coming. There was volatility. So because of the weather anomalies, because of the weather problems, there was increase in food inflation that was coming. And because of the increase in food inflation, the headline inflation was also increasing. Okay, so food inflation recorded an intra-year peak of 9.7% in October 2024. So this was the highest in the 2024-25. The food inflation was highest in October 2024, and it was low. It dramatically declined to 2.9% by March 2025. So there was a lot of fluctuations that were coming in food inflation, but food inflation remained elevated at 6.7% in 2024-25. Okay, and food inflation majorly affected the headline inflation. Now this is the conclusion for the inflation part. You can understand that headline inflation has moderated from 5.4% to 4.6%. This is because of the robust agricultural crop production the agricultural crop production increased in our country, due to which the food inflation was able to come down by March 2025, as well as the global commodity prices have started to soften. Food and energy prices, especially they softened because the fuel and energy prices, they were softening. Like food and energy prices, fuel prices were decreasing at the global level, due to which it can decrease in our country also. Easing supply chain pressures, there was lagged impact of monetary policy actions. So RBI had increased the repo rate, due to which the interest rate was increasing in the country, but it takes time. Okay, and that's why the lagged impact happened of the monetary policy actions. Food inflation, which remained elevated due to the weather patterns, due to the weather anomalies, they corrected in March 2025. So because of all these reasons, because of the robust agricultural production, because of the global commodity prices softening for the food and energy, for the food and fuel, and easing supply chain pressures, lagged impact of the monetary policy actions, food inflation also softened it was corrected by March. So due to all these reasons, the headline inflation decreased from 5.4% to 4.6%. Now core inflation softened to its lowest in the current series during the initial part of the year. So during the first half of the 2024-25, there was a lot of correction that came in core inflation, and core inflation decreased by a lot. So these are the reasons. Now, coming to the next part, considering the growth inflation dynamics. Now, what has happened that the growth rate has decreased or increased? Can anyone tell me that in India from 2023-24, the real GDP and the real GVA, they have decreased or increased for the 2024-25 in comparison to 2023-24. So the real GDP and real GVA, they have decreased or increased from 2023-24 to 2024-25. Anyone can tell me? We have seen. So actually the real GDP and the real GVA, they decreased, right, in from 2023-24 to 2024-25. So real GDP and GVA were decreasing. Now inflation rate, the inflation rate was also decreasing. So now the MPC, the Monetary Policy Committee, recognized that inflation rate has started to decrease, and we are expecting that inflation rate is further going to decrease in the future. So inflation is not the problem. And now we can shift our focus from the inflation to the growth. Now we have to focus on the growth because the growth rate has decreased immensely in our country. So we have to focus on growth. Okay. So now the focus of the Monetary Policy Committee shifted from inflation to growth. Now for the growth, what needs to be done? Repo rate needs to be reduced, because with the lesser repo rate, there will be lesser interest rate in the economy. With lesser interest rate, more loans will be taken, more car loans, home loans at lesser interest rate. The people tend to take loans, and with more loans, there will be more demand. With more demand, there will be more production. So now the MPC started to focusing on the growth. So considering the growth inflation dynamics, the Monetary Policy Committee changed the policy stance from withdrawal of accommodation to neutral in October 2024. So first of all, what happened? Before there was withdrawal of accommodation. First of all, there was withdrawal of accommodation. Withdrawal of accommodation means that in the future, either we are going to keep the repo rate constant, or we are going to increase the repo rate to control the inflation in the country. Okay. So this is the idea of the withdrawal of accommodation. So this was the point that in October 2024, it was decided that we are going to shift from withdrawal of accommodation to neutral. So see, in withdrawal of accommodation, this step is taken, or the withdrawal of accommodation, in this what happens that either the repo rate is going to be kept constant or the repo rate can increase in the future for decreasing the inflation. Neutral means that repo rate can increase, repo rate can decrease, repo rate can be kept constant. So in neutral, the repo rate can be decreased in the neutral monetary policy. So in October 2024, it was said that we are shifting from withdrawal of accommodation to neutral, so that we can shift we can change the repo rate as per the situation. Okay, so this was said because now the focus had to be given to the growth also. So it was said that we are shifting to neutral. Now in February 2025, actually after a long period of time, the repo rate was decreased from 6.50% to 6.25%. So repo rate was decreased, so that with decreased repo rate, there will be decrease in interest rate, and the loans, the demand can increase in the economy, the growth can increase in the economy. Okay, so this is the basic idea. I hope this is very much clear that considering the growth inflation dynamics, as the growth was lower and the inflation was also lowering, so now the focus can shift from inflation rate to growth. So it was said that the Monetary Policy Committee is shifting its stance from withdrawal of accommodation to neutral, and the monetary policy will see what happens in the future. So subsequently, with the growth inflation dynamics opening up the policy space to support the growth, the Monetary Policy Committee reduced the policy repo rate by 25 basis points from 6.5% to 6.25%. So repo rate was decreased from 6.5% to 6.25%, that is by 0.25%, that is by 25 basis points. Okay. So the repo rate was decreased in February 2025 after maintaining status quo, after maintaining the same repo rate since February 2023 at 6.50%. Now Monetary Policy Committee in April 2025, the repo rate is further decreased from 6.25% to 6%. So repo rate is further decreased by 0.25%, that is by 25 basis point, as well as the Monetary Policy Committee announced that we are shifting from the neutral stance to the accommodative stance. Accommodative stance means that in the future we are going to decrease the repo rate, or we are going to keep the repo rate constant. We are not going to increase the repo rate, basically. Okay. So Monetary Policy Committee decided to change the stance from neutral to accommodative. Accommodative means that Monetary Policy Committee is more focused on growth now, and the Monetary Policy Committee can decrease the repo rate or keep the repo rate constant. So withdrawal of accommodation means the repo rate can be kept constant or it can be increased. This is done for controlling the inflation in the country. Neutral means the repo rate can be kept constant, increased or decreased. So this is done when the RBI inflation might have to be controlled or growth might have to be boosted in the future. Anything can happen. Okay. So neutral stance is taken then when the image is not very clear for the future. Now the accommodative stance is taken when the repo rate is going to be kept constant or repo rate can be decreased. This is accommodative stance is taken for the growth focus, for focusing on growth. Okay, this is the idea. I hope this is clear. Now coming to the next point, employment. Now this data point you can use in your answer writing. This is very important data point. So here the unemployment rate remained unchanged in 2023-24. So you can see that unemployment rate, first of all, it has decreased from 2017 to 2018 to 2022-23. The unemployment rate decreased, okay, to 3.2%, and in 2023-24 also the unemployment rate remained at 3.2%. So the unemployment rate remained unchanged in 2023-24 at 3.2%. Now here you can see that the working population ratio, the worker population ratio has increased. The labor force participation ratio has also, the labor force participation rate has also increased. So that is good news that the unemployment rate is decreasing in our country and it has decreased to 3.2%, as well as it is good news that the worker population ratio is increasing. Now what is the labor force participation rate? First of all, what is labor force? What is labor force? So labor force consists of all the people. Labor force consists of all the people that are employed in the country above the age of 15, and the unemployed people. Unemployed people means the people that are unemployed but they are actively searching for job and they are willing to work and they are above the age of 15. It's not like that the child has just born and we are saying that this is unemployed. No, the child above the age of 15, if they are willing to work at the current wage rate and if they are able to work at the current wage rate, then they are unemployed. So unemployment has the definition: unemployed people are only those people that are willing to work at the current wage rate, they are able to work at the current wage rate, and they are above the age of 15 years. Okay. So, or they are at the age of 15 years. So, this is the unemployed. So, the labor force consists of the employed people in the country plus the unemployed people in the country. Labor force participation rate means that number of employed people, let's say 100 people are, let's say 50 people are employed. Let's say 20 people are unemployed out of the total population of 100. So that means labor force participation rate is what? Can you calculate this? What is the labor force participation rate here? Tell me the labor force participation rate. So labor force means all the employed people and all the unemployed people in the country. And unemployed people, I have told you that unemployed people are only those that are willing and able to do work and they are above a certain age. Now, labor force participation rate is all the employed and unemployed people, that is your labor force divided by the total population. So, labor force participation rate as per the data point that I have given is 70%, right? Next is worker population ratio. Worker population ratio means the number of employed people divided by total population. So, worker population ratio you can see has increased. That means the employed people in comparison or against the total population has increased. Okay. So, number of employed person against the total population has increased, worker population ratio has increased. Unemployed rate or unemployment rate is basically number of unemployed persons divided by labor force. Okay, number of unemployed person divided by the labor force multiplied by 100. So this is unemployment rate. Okay, so this is the idea. Now unemployment rate has decreased, labor force participation rate has increased, worker population ratio has increased. Next is the share of regular wage or salaried employees improved to 21.7% in 2023-24 as compared to 20.9% in the previous year. This is the idea of the employment, the data point for the employment. Now coming to the next point, that is the data points for the government. Okay, so central government delivered on its fiscal consolidation. Fiscal consolidation means, see, during the COVID, even Indian government had to spend a lot because the vaccines had to be provided, the health care facilities had to be provided, the ration has to be provided for the people that got unemployed during that time period. So the central government delivered on its fiscal consolidation commitment, that the central government said that we are reducing our deficit and we are focusing on reducing our debt, okay, with gross fiscal deficit. Now what is the formula of fiscal deficit? What is the formula of fiscal deficit? Fiscal deficit is equal to your total expenditure of the government. So fiscal deficit of the government is total expenditure of the government minus total receipts of the government, excluding the borrowing. So let's say the fiscal deficit is 100 crores. If the fiscal deficit is 100 crores, that means the gap between the total expenditure and total receipts of the government, excluding borrowing, is 100 crores. And this is the deficit of the government of 100 crores. That is the borrowing requirement of the government. This is the fiscal deficit, shows the borrowing requirement of the government, right? So fiscal deficit is total expenditure minus total receipts excluding borrowing, and fiscal deficit, if the fiscal deficit is of 100 crores, that means this is the borrowing requirement of the government. So if the government reduces the fiscal deficit, that means government reduces its borrowing requirement. Clear? Now, if the government reduces its fiscal deficit, that means government is reducing its borrowing requirement. Now, in the union budget of 2024-25, as per the budget estimate, the government promised that the government is going to reduce the fiscal deficit to 4.9% of the GDP. So this was as per the previous union budget. So as per the previous union budget of 2024-25, as per the previous union budget of 2024-25, the government promised that it is going to reduce the fiscal deficit to 4.9% of the GDP. But when the revised estimates came, in the union budget of 2025-26, as per the revised estimates for the 2020, so in the union budget, the revised estimates were released for the 2024-25, and as per the revised estimates, the fiscal deficit has further reduced to 4.7% 7% of GDP. Now, is this a good news or a bad news? Anyone can tell me? Is this a good news or bad news? Government promised in the previous union budget, the government promised that the fiscal deficit, as per the budget estimate, it is going to be 4.9% of the GDP. But as per the current budget, of 2025-26, the government showed the revised estimates for 2024-25, in which the government showed that actually we have done the fiscal deficit of only 4.7% of GDP. So this is good news that the government has further reduced its fiscal deficit. That means the government has further reduced its deficit and the debt requirement, the borrowing requirement. Got it? So central government delivered on its fiscal consolidation promise of decreasing the deficit and debt, with the gross fiscal deficit declining to 4.7% of GDP in 2024-25 as per the revised estimates from the 5.5% of GDP in 2023-24. Okay. So as compared to 5.5% of fiscal deficit in the previous financial year, the fiscal deficit further reduced to 4.7%. On the expenditure side, the effective capital expenditure. Now, you must have heard about the capital expenditure. What is capital expenditure? This is the expenditure that the government is doing to increase the assets in the country, or to reduce its liabilities, right? So remember this always, that the capital expenditure, see, revenue expenditure of the government, the revenue expenditure of the government is for the ongoing expenses. Like the salaries that the government is giving, pension that the government is giving, subsidies that the government is giving. So that is revenue expenditure, that is for the ongoing expenses of the government. Capital expenditure of the government is to increase the assets, and decrease the liability. So when the government is building the infrastructure, when the government is building the bridges, roads, flyovers and such, so that is increasing the asset. Decreasing the liability means government is reducing its loans or repaying the loans. So decreasing the liability means the government is repaying the loans. So this is decreasing the liability for the government. Okay. So this is the idea. So here on the expenditure side, the effective capital expenditure now means capital expenditure of the government, that is increasing the asset by the central government and decreasing the liability of the central government. Effective capital expenditure means capital expenditure of the central government plus the grants that the central government has given to the state governments for the capital formation. Okay, for the capital formation. So effective capital expenditure is your capital expenditure plus the grants and aid that is given by the central government to the state government for the creation of capital asset. So capital expenditure is the expenditure of the central government for the assets, for increasing the assets or decreasing the liability, and effective capital expenditure is equal to capital expenditure of the central government plus the grants that the central government has given to state government for the creation of capital asset. So that is effective capital expenditure plus the grants in aid to the state governments for creation of capital asset. Now on the expenditure side, the effective capital expenditure registered a growth of 5.2% over and above the growth of 19.8% in the 2023-24. So effective capital expenditure is increasing. That means capital formation is increasing in our country. That is good news. Now the effective capital expenditure stood at 4% of GDP in 2024-25 as per the revised estimates, and the effective capital expenditure would be 4.3% as per 2025-26 as per budget estimate. So effective capital expenditure, the government is trying to further increase the effective capital expenditure in the country. Now, next is, so growth in revenue expenditure. The revenue expenditure has also increased by 5.8% in 2024-25. Effective capital expenditure, just remember that 4% of the GDP in 2024-25, and the government is targeting 4.3% of the GDP in 2025-26. On the receipt side, the gross tax that the government collected and the non-tax receipts that the government collected. The non-tax means the profit that is, or the surplus that is going to the government. State Bank of India gave huge surplus to the government of India. The banks gave huge surplus to the government of India. RBI gave huge surplus to the government of India. There are different public sector undertakings that are giving their dividends to government of India. The government of India has given loans to the state governments on which the government of India is getting the interest also. So there are non-tax receipts of the government of India that the government is receiving. So on the receipt side, the gross tax and the non-tax receipts have increased percentages are not very important here. You can ignore it, but just the gross tax and non-tax receipts of the government has increased. Now coming to the states. This is for the central government. Now consolidated gross fiscal deficit for the states. Now if we take all the states together, the gross fiscal consolidated combined gross fiscal deficit of the states is likely to remain within the budget estimate of 3.2% of the GDP for 2024-25. Okay, so this was the budget estimate of 3.2% of the GDP. So gross fiscal deficit, the consolidated combined gross fiscal deficit of the states for the 2024-25 was budget estimated at 3.2% of GDP. Okay. Now, one thing that you need to keep in mind, if you have read the union budget, that is good. If you have not, then try to understand and remember that when the budget is released, budget estimates are released. This is for the future, that okay, in the future we are going to do this fiscal deficit, in the future we are going to do this expenditure, this receipts we are going to collect, that is for the future. That is the budget estimate. When the year finishes, then the revised estimates are released, that actually how much we have spent, actually how much we have received, actually how much deficit we have created. So for 2024-25, when the union budget was released, the budget estimates were released. And now the financial year 2024-25 has finished. So now the revised estimates have been released for 2024-25. Okay. So this is always the idea. Now coming to the trade. So India's merchandise exports, India's merchandise, that is the goods exports, grew marginally by 0.1% in 2024-25 as against a contraction. You can understand that the goods exports, they were contracting or they were decreasing by 3.1% in 2023-24. Now they have marginally increased. 0.1% is the growth in the goods exports. As compared to that, the merchandise imports, that is the goods imports that India is doing, has grown by 6.2%. So exports are growing by 0.1% while the imports are growing by 6.2%. So can you tell me that this will create, like, the deficits will increase or the surplus is going to increase in the country? In the trade, in the goods trade, in the merchandise trade, the exports have grown by 0.1%. Imports have grown by 6.2% in the financial year. So this will create more deficit in the goods trade, or this will create surplus, or it will balance out the situation. Deficit, correct. Deficit will increase, okay? Because you can understand that we are doing, the exports have increased but very slightly as compared to the huge increase in the imports. So that is going to further increase the deficit in our country. That is going to further increase the merchandise deficit in our country. And here we are talking about the goods exports and the imports of the goods. Thank God that in our country we have a strong service sector. So service sector is always able to provide support, okay, to the goods situation. So here you can see India's mercantile trade deficit widened. The trade deficit in goods has widened. Now, how many of you know about the current, in the balance of payment, we have the current account. In the current account, we have three components, that is the trade in goods. Now, in the trade in goods, the export has grown slightly, the imports have grown a lot, and that has created the huge merchandise or trade deficit. The merchandise trade deficit has been created, okay? Huge merchandise trade deficit or huge deficit has been created in the goods section. Now then there is trade in services. Now trade in services was in surplus because the exports in the services was way higher than the imports. Now third part or third component of current account is the transfer payments, the remittances that we receive. We provide the remittances also, like we send the money to the relatives that are living in US, to the relatives that are living in US, UK, but we get a lot of remittances, and the remittances that we are receiving is way more than the remittances that we are giving. So transfer payments, remittances that we receive was way higher, so it was also in surplus. So the surplus in transfer payments and the surplus in trade in services covered up the deficit in the trade in goods, okay? So because of the strong services exports and a steady flow of inward remittances, the inward remittances that we received, under the transfer payment, the remittances that we are receiving. So with the strong service exports and the inward remittances that we received, it was able to cover a part of the deficit of the trade in goods. It was able to cover a part of the deficit in the trade in goods. So strong services exports and a steady flow in inward remittances cushioned India's current account deficit. So you can understand that trade in goods is in deficit of 100 rupees. The trade in services is in surplus of 70 rupees and transfer payments was in surplus of 20 rupees. So the surplus of trade in services and transfer payment of 90 rupees covered a part of the current account deficit, and the current account deficit that was left was 10 rupees only. Okay, so this is the idea, that the services and the inward remittances cushioned India's current account deficit to remain within the sustainable level at 1.3% of the GDP as compared to 1.1% of the GDP that was in the previous financial year. Okay, so this is the idea. Any confusion here, anyone? So in the current account, trade in goods was in deficit of 100 rupees, let's say. Trade in services was in surplus of 70 rupees and transfer payments was in surplus of, the remittances that we received was in surplus of 20 rupees. So this surplus of services and the inward remittances, the transfer payments covered a part of the deficit, but still the current account deficit remained. So current account deficit was at 1.3% of the GDP as compared to 1.1% a year ago. This is for, see, April to December. Whenever you see the trade data, it is only provided for April to December. Okay. So net, now this was regarding the current account. Now we have the capital account. In the capital account of the balance of payment, there is the investment. We receive the investment from outside. We provide the investment to other countries. We receive the foreign direct investment. We receive the foreign portfolio investment. We do the investment in other countries also. Then in capital account, we have the borrowings, the external commercial borrowings, the short-term debt that we are taking, as well as we provide the lending also, and the assistance also comes under capital account. So in the capital account, the net foreign direct investment inflows stood at $0.4 billion. So the net foreign direct investment, that is the net investment that we received, it stood at $0.4 billion as compared to nearly $10 billion that we received in the previous financial year. The financial portfolio investment recorded net inflows of $1.7 billion as compared to $41.6 billion that we received in the previous year. So you can understand that the foreign direct investment was in positive. The net foreign direct investment that we have received, the net foreign portfolio investment that we have received was in positive, but it is way lower than the 2023-24 financial year. So that is also a problematic situation, that net foreign direct investment, we have seen, like, we have the positive inflows in the net foreign portfolio investment also, we have the positive inflows, but the inflows of this year, this financial year, is way lower than the inflows of the previous financial year. So that also created a problem. So now you can understand that overall there was a depletion. Now the current account was in deficit. The current account was in deficit, and the capital account was in, like, it was in surplus. So current account was in deficit of 50 rupees, but the capital account was in surplus of 30 rupees. So the balance of payment will be in deficit because the deficit is larger. So the RBI had to release the foreign exchange reserves. The RBI had to, like, to cover up this deficit in the balance of payment situation, to cover this deficit, the Reserve Bank of India had to release the foreign exchange reserves. So overall, there was a depletion in the foreign exchange reserves to the tune of $13.8 billion during April to December 2024. This was because of the the capital account was in surplus, but it was not able to cover the deficit of the current account, and this deficit is mainly being created by the merchandise trade. Okay. So nonetheless, strong buffers in the form of ample, like, we have good foreign exchange reserves, and that's why it was able to cover up the deficit that was created in the April to December 2024, as well as this ample foreign exchange reserves that we have, it provides the covers of 11 months of merchandise imports, of the goods imports, helped mitigate the external financing needs and such. Okay, so the foreign exchange reserves that is kept with the Reserve Bank of India, it is able to cover the merchandise imports for 11 months at least. Okay, this is the idea. Now coming to the next part, that is the outlook. Now we have discussed the assessment. that we have discussed the data point for 2024-25, we have discussed the data point for 2024. Now we are going to discuss the data points for the future. Okay, so the outlook. Now we are going to discuss the data point for 2025-26, that is for the coming financial year, that is ongoing, we can say. So outlook for the Indian economy remains promising, supported by the revival in the consumption demand of our country, the government's continued support that is given to the capital expenditure, the government's continued thrust that is in the capital expenditure, while adhering to the path of fiscal consolidation, that the government is reducing its deficit and the debt, healthy balance sheets of the bank. So all of these are creating a positive outlook for the country. So as per the outlook situation, the real GDP growth for 2025-26 is projected at 6.5%, and the CPI inflation, the headline inflation, the retail inflation for 2025-26 is projected at 4%. The impetus to growth inducing capital spending. So the government is going to do more capital expenditure. This would be sustained by the central government. Central government is going to do more capital expenditure, with effective capital expenditure budgeted to rise to 4.3% of the GDP from the 4% of the GDP. Okay, so we are going to further focus on effective capital expenditure. The central government adhered to its medium-term objective of bringing the gross fiscal deficit below 4.5%. So this is the target of the government, that we have to decrease the fiscal deficit below 4.5%, and that's why as per the 2025-26 budget estimates that were released in the union budget, the gross fiscal deficit for the 2025-26 is targeted at 4.4% of the GDP. That will be down from 4.7% of 2024-25. Okay. Next is for 2026-27 onwards, the central government aims to maintain the fiscal deficit on a trajectory that ensures that we have a declining public debt to GDP ratio. So we want that the public debt to GDP ratio should decline and should reach around 50% by end March 2031. Sorry. So this is the data points for the future, the prospects for the future. Okay. Now fiscal outlook, that is the government outlook for states. That is for the states now, remains positive for 2025-26, and we are expecting that the gross fiscal deficit for the 2025-26 will come at 3.3% of the GDP. This is as per the data points of 28 states and 3 union territories. Now gross transfer to states from the central during the 2025-26 is budgeted to increase by 12.5%. Okay, so the central government has to provide money to the states. So it is budgeted that central government is going to provide even more money by 12.5% to the state governments, driven mainly by tax devolution. So central government passes on a part of tax to state government. Centrally sponsored schemes, for that also the money will be transferred. Okay, so the money will be transferred 12.5% higher. Now this is in the part 1 we have completed the chapter 1. Now we are going to move to the chapter 2. Any confusion till now? So see, the real economy data we have already discussed. The price situation data we have already discussed. So all the data points that were present here, so I merged it with the above slides, so that at one, like we are not repeating the same data again and again. Okay, so these two parts we have already completed here. Now we are going to start with money and credit. Okay, so starting with money supply. Okay, so starting with money supply. So the Reserve Bank's balance sheet size moderated to 22.8% of the GDP as compared to 23.5% of the GDP in the previous year. Okay, so this is the idea. So Reserve Bank's balance sheet. So the Reserve Bank's balance sheet moderated to 22.8% of the GDP at the end of March 2025. At the end of March 2025, mirroring the trend observed in other major economies also. Now the M3, that is the money supply. So Reserve Bank of India calculates the money supply in our country through the M3. So M3 recorded a growth of 9.6%. So the money supply, that is the M3, it recorded the growth of 9.6%. So money supply grew by 9.6% as compared to 11.2% in the previous financial year. Okay, so this is the idea. Now coming to the next point, that is credit growth. Double-digit growth has happened in the bank credit. This was sustained during the 2024-25, same as the previous years also. So double-digit growth has happened in bank credit. So bank group wise, if you see the public sector banks, in the public sector banks, there was higher share. So share in total scheduled commercial bank credit. So the higher share is with the public sector banks. Okay. So bank group wise, public sector banks registered a higher credit growth than that of private sector banks, as well as in the total credit share, the public sector banks had a higher share also. They have higher growth also. Okay. So this is the idea. Now, with the former maintaining the largest share in total credit. So the public sector banks had the largest share in the total credit, as well as they have registered higher credit growth also. Next is scheduled commercial banks deposit growth remained below that of bank credit. So basically what has happened that the deposits have also grown, but the credit has grown faster, or there is more growth in the credit sector. Okay, so deposits have grown, but the credit has grown more. And the difference, but what has happened that the difference between the deposit and credit has reduced. So before there was a huge difference between the deposits and credit, but now it has reduced to a certain level. Okay, so here you can see that the wedge between the credit and the deposit growth has reduced in the previous financial year. So scheduled commercial bank deposit growth remained, like the growth has happened in the deposit, but it was lesser than the growth in the credit. However, the wedge or the difference between the credit growth and deposit growth, this has decreased. Now coming to the next point, that is the highest growth that has come in the retail segment. So bank credit expansion, so the credit growth that we have seen, the bank credit expansion was largely broad-based, led by the personal loans, the retail loans, the service loans, and the agriculture sector loans. Okay, so this is the idea that bank credit expansion was largely broad-based, but the highest growth that has come, highest percent growth that has come was in retail sector, then in services sector, and then in agriculture sector. Okay, so this is the idea. Now coming to the next part, that is central government finances in 2023-24. So this data point we have seen previously also, but here we will kind of revise the data points. So during 2024-25, revised estimates that were released in the current union budget of 2025-26. So in the current union budget of 2025-26, there were the revised estimates that were released for the 2024-25, as well as budget estimates were released for 2025-26. Okay, so budget estimates are released for 2025-26 and revised estimates are released for 2024-25. So during the 2024-25 revised, the union government contained the gross fiscal deficit at 4.7% of GDP, that is lower by 0.2% of the budget estimate. So as I have told you that in 2024-25 budget estimate, it was said that the gross fiscal deficit will be 4.9% of the GDP, but in the revised estimates, we have seen that the gross fiscal deficit is only 4.7% of GDP, that is lower by 0.2% of the budget estimate. Okay, primarily through containment of revenue and capital expenditure. So this is because, so fiscal deficit has reduced because of decrease in revenue and capital expenditure. So here you can see that the fiscal deficit has decreased from 5.5% of 2023-24 to 4.7% of 2024-25 as per the revised estimates. Okay. Next is that capital expenditure, though the government wanted to do even more capital expenditure, but here you can see that capital expenditure undershot but the budget estimate. So as per the budget estimate, the capital expenditure that was decided, but as per the revised estimate, it was seen that the capital expenditure was slightly lower than the budget estimate. Okay, so capital expenditure undershot the budget estimate by 92,000 crores and was placed at 3.1% of the GDP. So as per the revised estimate of 2024-25, the capital expenditure was 3.1% of the GDP as compared to the 3.2% of the GDP in the previous financial year. The union budget for 2025-26, the budget estimates that were released stated that the fiscal deficit will be reduced to 4.4% of the GDP. So that is good news that further the fiscal deficit is going to decrease. And this is expected to be driven by moderation in the revenue expenditure, by decreasing the revenue expenditure from 11.2% to 11%. So revenue expenditure is going to further reduce. So here, as well as the focus will be given to enhance the tax and non-tax receipts. Okay. Next is that capital expenditure is budgeted to grow by 10.1%. So capital expenditure is budgeted to grow by 10.1% and is estimated at 3.1% of the GDP for the 2025-26 also. The effective capital expenditure is going to increase to 4.3% of the GDP from the 4% of the GDP. Okay. Next is strong performance of income tax and GST. Now there is strong performance that we have seen in income tax. You can see that income tax has increased from 2023 to 2023-24 to 2024-25, as well as there is the increase in the goods and services tax. The goods and services tax has also increased. So there is strong performance of income tax and GST, bolstered tax receipts. So tax performance increased or it improved, while growth in custom duty slowed. Growth in custom duty and the growth in union excise duty that reduced, but there was huge growth in income tax and goods and services tax that we have seen. Now next is that the gross tax revenue, the total tax revenue. See, gross tax revenue is budgeted to reach its peak of 12%. So the total tax revenue, it is expected or it is budgeted to reach its peak of 12% of the GDP in 2025-26, highest after the 2007-2008. Okay. Next conclusion, that government is focusing on fiscal consolidation through rationalization of revenue expenditure, decreasing the revenue expenditure from 11.2% to 11%. From 11.2% to 11%. So government is focusing on fiscal consolidation, reducing its expenditure by reducing the revenue expenditure basically, and enhancing the revenue generation by increasing the tax, or like collecting more tax basically. Next, state finances. So states had budgeted a gross fiscal deficit of 3.2% of the GDP in 2024-25, but actually as per the revised estimates, the 2024-25, the state gross fiscal deficit was 3.6%, so that is higher. So states had budgeted that their gross fiscal deficit will be 3.2%, but as per the revised estimates, their gross fiscal deficit was 3.6%. Now for the future, for 2025-26, they are budgeting their gross fiscal deficit at 3.3%. Okay. Coming to the next idea, that is the external sector. So basically India's merchandise exports or the trade exports, the India's trade exports have increased slightly from the contraction of 3.1% to the expansion by 0.1%. So the India's exports, the merchandise exports or the goods exports have increased slightly, while the goods imports or the merchandise imports have increased from the contraction of 5.3% to the expansion of 6.2%. So imports have grown immensely, we can say. So here, this is the idea that the exports have marginally, very slightly, they have increased by 0.1%, but the imports, the merchandise imports have increased very, like they have expanded by 6.2%. Okay, and the relative contribution of major sectors to export growth. So export growth is majorly coming from electronic goods, engineering goods, drugs and pharmaceuticals, rice and ready-made goods. So these are the main areas from which the export growth is coming. Now the expansion that we have seen in the merchandise imports. So the import growth is coming from the import of gold, electronic goods, petroleum, crude and such products. Okay, so the import growth, expansion in merchandise imports in 2024-25 was led by gold, electronic goods and petroleum, crude oil and products. So this is the idea. Now next point is services sector. So we have seen, now this is the idea for the trade in goods. This is the idea for the trade in goods. So trade in goods is in deficit. It is in deficit. Why? Because the export growth is not much while the import growth is very high. So the trade balance, you can see that there is the deficit that we have. Don't need to remember the numbers, but basically in the balance of trade or in the merchandise trade, there is a deficit, huge deficit that we have faced. Now coming to the trade in services. Okay, so net services exports have increased by 12.9%. So that is a very good percentage, that the net service exports, after deducting the imports, the net service exports have increased by 12.9%. This is because of the expansion in the software and the business service exports. So the software and the business service export account for around 74% of India's service exports. So mainly our exports happen of the software exports and the business service exports. Okay, here you can see that India is among top 5 countries. So in the global commercial service trade, India retained its position among the major 5 exporting countries in the terms of service export growth during the 2024-25. Okay, so India is among the top 5 countries when it comes to the service export growth, and the service sector is like holding the country of India, or we can say the service sector is holding India. Now, India remained the top remittance recipient in 2024. So you can see that the highest remittances have been received by India. So it is our country that receives the highest of the remittances from the other countries. Okay, so here you can see that India's total remittance receipts stood at $137.7 billion during the 2024. So strong services. Now, as I have told you that in the current account, trade in goods, the trade in goods is in huge deficit, but that is like the huge deficit that is in trade in goods, that is controlled slightly by the trade in services, by the surplus in trade in services, and by the remittances, inward remittances, or the transfer payment that we are receiving. Okay, so this is the idea. Now here the buoyancy in net services receipts and workers' remittances largely offset the expense in merchandise trade deficit. Okay, so the net service receipts that we have got, the transfer payments that we have got, the remittances that we have got, that is offsetting a huge part of the deficit of the merchandise trade. Accordingly, India's current account deficit stands at 1.3% of the GDP as compared to the 1.1% of the GDP in the past year. Now coming to the next part, that is your FDI, and see, try to understand that whenever we say net FDI means how much foreign direct investment we are receiving from the foreign investors in our country, minus how much foreign direct investment Indian investors are doing in other countries. So this is net FDI. Let's say we are getting the FDI from foreign investors of $100, and we are doing the FDI, the Indian investors are doing the foreign direct investment of $70. So the net FDI will be $30. So how much we are receiving from foreign investors minus how much we are doing the investment in the foreign countries. So that is net FDI. So here you can see that in the net FDI, first of all, gross foreign direct investment, the total foreign direct investment that we have received is $81 billion. Now we have received so much, but at the same time, we have received $81 billion. We have received $81 billion. Okay, $1 billion. But at the same time, there is like many of the foreign investors, they are taking out their money. They are selling their shares. So foreign direct investment has reduced in the Indian companies. So there is the disinvestment that is happening. There is the disinvestment that is happening in the Indian companies. So this investment or repatriation was of $51.5 billion. And that's why the net inward FDI, the inward FDI or the FDI that we have actually received is not $81 billion, but because there is some disinvestment that has also happened. So the net inward FDI was only $29.6 billion. Okay, so net inward FDI was $29.6 billion, and net outward FDI, that is the foreign direct investment that we have done in the other countries. So outward FDI was $29.2 billion. So we have received the net. We have received the net inward FDI. The inward FDI that we have received is $29.6 billion, while the outward FDI that we have done is $29.2 billion. So in total, the net FDI is only $0.4 billion. And you only have to remember the data of net FDI basically. So net FDI is $0.4 billion. That is way less. That is way less as compared to the net FDI that we received in the last year. Okay. So the net FDI is quite low in our country in this year. Next is globally, India was placed 4th in terms of Greenfield FDI. Now, Greenfield FDI, this is the new foreign direct investment that is coming in our country. That is the investment that is happening in new projects and the projects from the ground up. Okay, that is the projects that are just starting in the country. So India was placed 4th in terms of Greenfield FDI, the new capital investments that are happening in our country for opening up stores, for opening up subsidiaries, branches from the ground up, from the very basics. Okay. So this is the idea, like India is 4th after US, France and UK. Next is net FDI flows in our country. So net FDI inflows was only at US dollar 0.4 billion during the 2024-25. That is way lower than the 10.1 billion of the net FDI in the previous year. According to the United Nations Conference on Trade and Development, India is emerging as a major source of global FDI, ranking among the top 20 source countries in 2023. So we are actually doing a lot of FDI also in other countries. You can see the net outward FDI is quite high also. Okay. Next is that source country wise inflow of FDI. So we have received the highest FDI from Singapore, Mauritius, US, Netherlands and UAE. These 5 countries combined have contributed 3/4 of the FDI flows to our country. So we have received the highest foreign direct investment from these 5 countries. While the FDI that we have done, so we have done the major destinations for India's outward FDI. So the FDI that we have done in the other countries was majorly in Singapore, US, UAE, Mauritius and Netherlands. Okay. So which 5 countries have contributed most in our country? That we have to remember. Which 5 countries we have contributed most? So that we have to remember. Now, external commercial borrowings. So during 2024-25, the foreign portfolio investment, now we have discussed about the foreign direct investment, right? We have discussed about the foreign direct investment. Now coming to the external commercial borrowings and the foreign portfolio investment. So during 2024-25, foreign portfolio investment registered a net inflow, the net inflow of US dollar 1.7 billion. That is higher than the FDI, but it is way lower than the FPI that we received in the previous financial year of $41.6 billion. You can understand that in 2023-24, we received $41.6 billion in net FPI, while in this year, we have only received $1.7 billion in net FPI. So that is a problematic situation. Now the FPI inflows, the foreign portfolio investment that was majorly coming, it was coming in debt segment, because in our share market, there was outflow that was happening. Okay. So basically, the foreign portfolio investment is the investment in the debt market of our country, in the securities market, in the share market of our country. So net FPI, first of all, it was positive, but it has decreased immensely from the previous year. And the major inflows that have come in the debt market. So debt segment witnessed steady FPI inflows amounting to US dollar $17.4 billion on the back of inclusion of Indian sovereign bonds. So Indian government bonds were included in the global bond indices. So that's why we received good debt, good inflow in the debt market. Equity FPI flows, however, recorded a net outflows. So majorly in the equity segment, there was the outflow that was happening because many of the foreign investors, they didn't want to invest in the Indian companies, in the Indian shares, in the shares of the Indian company basically. So the equity FPI flows, however, recorded net outflows of US dollar 15.7 billion during the same period. So in the debt market, net inflow has happened. In the equity market, there is net outflow that has happened. So in total, FPI had the net inflow of only $1.7 billion. Okay. Next is during 2024-25, the net external commercial borrowings. Now we borrow from outside also. Okay. So in the capital account, we have the investment, that is the foreign direct investment and foreign portfolio investment, the borrowings and the assistance. Okay. So the external commercial borrowing, the net external commercial borrowing inflows happened. That means we borrowed from outside. So this rose significantly to US dollar $18.7 billion from the US dollar $3.6 billion. Now that means we are borrowing more from the other countries. And here you can see that external commercial borrowings, this has increased to $18.7 billion as compared to $3.6 billion. Okay. India's external debt to GDP ratio remained modest at 19 points. So our external debt to GDP ratio, this has remained modest at 19.1%. As compared to 18.5% of the last year, the lowest among the emerging market peers. Okay, the share. Now see, the problem is in the short-term debts. Why the problem is in the short-term debts? Because if a company is taking the short-term debt, that company is taking the debt for its operating expenses rather than for investment, because long-term debt shows that, okay, the company is doing the investment, the company is expanding. short-term debt shows that the company is only taking the borrowing for its operational expenses, for its salaries and such. So that seems problematic. Okay, so the share of short-term debt in total external debt has declined to 42.4% as at end of December 2024. So this is good news that at least the short-term debt is decreasing. Okay, so now we have seen that the current account balance. So this we have discussed in 44th half yearly report on management of foreign exchange reserves. This we have discussed in the Finance 360-degree session. In this also the balance of payment data was shown for April to December 2024. So the current account balance was negative 37.1 in the current account because of the huge merchandise trade deficit. The current account was in deficit of $37.1 billion, while the capital account was in surplus of 23.3 billion dollars. So you can see that the surplus of capital account is only able to cover a part of the deficit of current account. The rest $13.8 billion, that was the deficit in the balance of payment. In the total, the deficit is left of $13.8 billion. So that had to come from foreign exchange reserves. So RBI had to release the foreign exchange reserves of $13.8 billion. Okay. Now, foreign exchange reserves continue to provide a strong buffer for mitigating the external risk. And if we see the foreign exchange reserves as at the end of March 2025, it is still providing a cover of 11 months of merchandise imports on the balance of payment basis. And India's external sector has displayed resilience, because it's not like that the problem is coming in our country only. The problem is coming at the global level because of the trade war, protectionism policies that the different countries are adopting. Okay, but still India is remaining resilient. Now we are going to start with part 2. Any confusion anyone has till now? Any confusion, anyone? So we have completed the part 1. We have completed the prospectus and the assessment part. Now we have moved to the part 2. Yes, Balabi. I will, like, at the end of the session, I will tell you that which data is important and such. Okay. Okay. Now we are going to move forward with the part 2, the working and operations of the Reserve Bank of India. The good news is that you have studied 90% of this part already, because you have studied the monetary policy committees, you have studied the different operations of the Reserve Bank of India. So I'm going to tell you the important points here, which points are important from descriptive point of view, which points are important from the objective point of view. And I will give you the additional points also as per the report. Okay. So part 2, the working and operations of the Reserve Bank of India. First of all, the monetary policy operations. So monetary policy operations, basically the monetary policy committee, it announced in October 2024 that it is going to withdraw, it is going to shift its stance from the withdrawal of accommodation to neutral in October 2024, and subsequently it reduced the policy rate by 25 basis point in February 2025. So in February 2025, the repo rate was decreased from 6.5% to 6.25%. Okay. And in April 2025, the repo rate was further reduced from 6.25% to 6%. Okay. Now the CRR of banks was reduced to 4%. And can you tell me, anyone, that in how many tranches were CRR reduced? So CRR, the cash reserve ratio, was reduced from 4.5% to 4%. Now in how many tranches the CRR was reduced? If you have studied in the past year, you will know. If you do not know, then also do not worry, I will tell you now. In how many tranches? In 2 tranches. That means the CRR was reduced from 4.5% to 4.25%. Then the CRR was reduced from 4.25% to 4%. In the month of December only, the CRR was reduced in 2 tranches, 4.5% to 4.25%, 4.25% to 4%. Okay. So this is the idea that because there was the to inject the durable liquidity during the January-March 2025. So to provide the liquidity in the economy, because the liquidity was in deficit, the money supply was less in our country. So to provide the liquidity, to inject the liquidity, the RBI reduced the CRR. The RBI reduced the CRR from 4.5% to 4%. Just a second. Okay, so here the CRR was reduced from 4.5% to 4%. Now CRR is the cash reserve ratio, the reserves that the bank has to keep with the Reserve Bank of India. Okay, so if the CRR is reduced, that means the banks have to keep less reserves. If the CRR is reduced, that means the banks have to keep less reserves with the Reserve Bank of India. That means the bank will be left with more money to lend. So this was to inject the liquidity into the economy. Next, during the year, system liquidity moved. See what happened, that deficit happened. The money supply was in deficit during December 2024 to February 2025. So money supply was lacking in the country. There was not enough money supply in the country. So if there is not enough money supply in the country, if there is not enough money in the country, the RBI had to inject the liquidity. Now RBI undertook various measures to inject the liquidity into the economy, such as the RBI did the open market operation, where the RBI purchased the government securities from the banks, and for purchase of government securities, RBI provided huge money to the banks. Okay, RBI provided the money to the banks. RBI also conducted the swap facility. It bought the dollars and it provided the rupees to the banks. Okay, so rupees was further injected into the economy, into the system. Okay, long-term swap facility was also done. Long-term swap was also done, in which RBI bought the dollars and RBI released the rupees. Okay, the CRR was reduced from 4.5% to 4% in 2 tranches. Okay, so these are certain steps that the RBI has taken. These are the certain steps that the RBI has taken to improve the liquidity into the economy. So now the reduction of the CRR, released primary liquidity of about 1.16 lakh crore to the banking system. So RBI reduced the CRR, that is RBI reduced the reserve requirement. So this increased the money with the banks. So this increased the liquidity by 1.16 lakh crore, as well as RBI undertook various other measures also. So during the year, the deficit was there in the liquidity. So RBI undertook various measures to increase the liquidity in the economy. The RBI also reduced the repo rate in Feb 2025. So with the less repo rate, repo rate is the rate at which banks take loans from the RBI. Okay, repo rate is the rate at which the banks take loan from the Reserve Bank of India. If the repo rate is lower, that means at lesser interest rate, the banks will take more loans from the Reserve Bank of India. If bank take more loan from the Reserve Bank of India, the banks will have more money to lend. So RBI also decreased the repo rate. The RBI also decreased the repo rate, as well as if the repo rate is decreased, the interest rate in the economy also decreased. And with the lesser interest rate, the people started taking more loans and the demand also increased in the economy. Okay. So this is the idea. Now, what is the external benchmark linked lending rate? First of all, this was introduced in October 2019. Since then, all the banks, they have to link their retail floating rate loans. That means their retail loans that has the floating rate, the like the volatile or the changing rate, and the MSME loans have to be linked to the external benchmark. So basically, the RBI said in October 2019 that all the banks have to link they have to link their interest rate with the repo rate. Okay, and this linkage between the interest rate and repo rate was through the external benchmark linked lending rate. So the interest rate that the banks follows, or the interest rate that the bank has, they are dependent upon a benchmark rate. And as the benchmark rate fluctuates, the interest rate also fluctuates in the economy. So the RBI said that this benchmark rate for the banks will be repo rate of the Reserve Bank of India, specifically for the retail loans and MSME loans. So if the repo rate is decreased, the repo rate is the benchmark rate, so the interest rate have to be decreased by the banks. This is the basic idea. Okay, so since October 2019, all the banks have to link their retail loans that have the floating rate, that have the changing rate, and the MSME loans to the external benchmark as per the Reserve Bank of India's dictate, and in case of most banks it is the repo rate. So this is the basic idea. Any confusion here? External benchmark linked rate, clear? So basically the interest rate that the banks have, they are dependent upon the benchmark rate. It's not like that the benchmark rate is 6%, so interest rate should also 6%. No. Basically, it means that as the benchmark rate is moving in same direction, the interest rate should also move for the banks. Okay. So the interest rate of the banks depend upon this benchmark rate. RBI said that for the retail loans and MSME loans, mostly the benchmark rate should be repo rate. So if repo rate is increased, interest rate should increase in the economy. If repo rate is decreased, interest rate should decrease in the economy, basically. Okay. So repo rate was decreased. The repo rate was decreased in February 2025. So this decreased the interest rate in the economy, further boosting the money into the economy. Okay. The share of EBLR linked loans in total outstanding floating rate loans of the public sector banks stood at 44.6%, whereas it was 85.9% for the private sector banks. So you can understand that more and more loans are getting linked to the external benchmark linked rate, that is mostly the benchmark is the repo rate. Next is on October 1, 2024, the central government notified the reconstitution of the Monetary Policy Committee. As you know, that Monetary Policy Committee has 6 members. So out of these 6 members, 3 members are nominated by the Government of India. So the Government of India nominated the new 3 members in October 2024. Okay, so this is the idea. Now coming to the chapter 4, that is credit delivery and financial inclusion. Any confusion in the previous chapter? Okay, next is credit delivery. Okay, so here you can see that there were various things that were implemented by the Reserve Bank of India in 2024-25. Okay, so this is the implementation status that we are first discussing. So the Reserve Bank of India, the expanding and deepening of digital payment ecosystem program, this was extended to all the districts in August 2023, except 2 districts of Andaman and Nicobar and 1 district of Manipur. So except these 3 districts, the EDDPE, that is expanding and deepening of digital payment ecosystem. So basically the program, it expands the digital payment ecosystem in all the districts of the country. Okay, so this program was expanded to all the districts in August 2023. It was announced, or it was extended for all the districts. So RBI had given the target that in 2024-25, at least 50% of the districts, 50% of the districts have to be completely come under the program. So as on March 31st, 2025, 100% coverage has been achieved in more than 60% of the districts. So basically the RBI had given the target of 50% for 100% coverage, but the RBI has achieved more than the target of 50%. So as on March 31st, 2025, 100% of the coverage under the program has been achieved in more than 60% of the districts across the country. This includes all the districts in 15 states and 6 union territories. So in these 15 states and 6 union territories, all their districts have come under this program for the expansion and deepening of the digital payment ecosystem. This is the idea. Okay. Next point is that MSMEs. The focus, it was said that we in the financial year 2024-25, we will focus on the MSME lending and we will reduce the challenges for the MSME lending. Okay, so to address the challenges in the MSME credit, to address the challenges in the MSME credit, especially the for the micro small enterprises, for these these were the instructions that were released for the banks, okay, or for the regulated entities. So scheduled commercial banks have been advised to have a uniform turnaround time of 14 days for loans up to 25 lakh for micro and small enterprises borrowers to ensure faster disposal of such loans, faster providing of such loans and disposal of such loan applications, completing these loan applications. So turnaround time, that means completing, receiving the application and completing that application, seeing that application. So turnaround time should reduce to 14 days. So scheduled commercial bank, they were advised to have a uniform turnaround time of 14 days for loans up to 25 lakh for the micro and small enterprises. it was reiterated to the banks to implement a credit proposal tracking system where the micro, small and medium enterprises, they can track that their loan application, why it has been rejected, if it has been rejected, why it has been rejected. So reason has to be given. And through this credit proposal tracking system, the MSMEs can see that which documents they require for taking the loan, as well as through this tracking system, they can also see the pendency, that where in which particular level the loan is pending. Okay, so it was reiterated to banks to implement a credit proposal tracking system and inform the MSME borrowers in writing the main reason of rejecting the loan application, that why it has been rejecting, furnish them with all the checklist, that which documents they require, as well as display the pendency position of loan applications on their website. So this credit proposal tracking system had to be developed by the banks. This has to be implemented by the banks. Now, guidelines were released by the RBI on cluster financing. These were reviewed to provide a clear definition of clusters. So, as per the Reserve Bank of India, the definition of cluster is that MSME clusters, the micro and small enterprise clusters, they have now been defined as those clusters that are identified by the Ministry of MSME, Government of India and state governments. Okay, so micro small enterprises, these micro small enterprises clusters, they have been defined as those clusters that are identified by Ministry of MSME, Government of India and state governments. And the lead banks that are present in different districts, that are present in different states, they have to boost the credit to these clusters. Okay, this is the idea. So to reduce the challenges for the MSME credit and to address these challenges that are coming in the MSME credit, it was said that turnaround time has to be uniform of 14 days and credit proposal tracking system has to be implemented. The MSMEs have to be told about the reason that why the loan application is cancelled, and cluster financing should happen. The lead bank should provide more of the credit to the clusters, okay, and focus on the clusters also. So priority sector lending guidelines were comprehensively reviewed and revised. Master directions on priority sector lending were issued on March 24, 2025. Now the priority sector lending guidelines were reviewed. So this we have discussed in detail. I have taken a detailed session on the priority sector lending guidelines, so that you have to see, because priority sector lending guidelines are very important. Next is major developments in the credit delivery. So basically the Kisan credit card, this is a single window facility through which the farmers can take the credit for the working capital, for the farming that they have to do, as well as investment credit, like for the tractor that they want to buy, or for the raw materials and such things that they want to buy. So farmers for cultivation and animal husbandry and fisheries, they can take the Kisan credit card, they can take the loan or money under the Kisan credit card. Now the number of operative Kisan credit cards have decreased by 2.7%, while the outstanding amount have increased, or the amount that has to be returned has increased by 4.5%. So outstanding amount has increased by 4.5%. Now coming to the priority sector lending targets. So the scheduled commercial banks, they have achieved more than 40%. So the scheduled commercial bank has to provide 40% to the priority sector, and they have achieved more than that. 43.1% they have achieved. Okay, here you can see that public sector banks, private sector banks, foreign banks, they all have to provide 40% of the lending or 40% of the adjusted net bank credit to the priority sectors, but they have achieved more than 40%. So they have achieved more than the target. Next is enhancement of collateral-free agricultural loan. So what happened that in the previous year, you must have seen that in 2023, there was a lot of inflation that was coming in the economy, and in 2024 also the inflation, though it was decreasing, but it was still high. So keeping in view the inflation, the rise in agricultural input cost and overall inflation, the limit for collateral-free agricultural loans, it was raised from 1.6 lakh to 2 lakh per borrower in December 2024, so that further money can be provided to the farmers so that they can sustain their activity and they can continue farming. Next is bank credit to MSME sector. So bank credit to the micro, small and medium enterprises sector, this has increased by 14.8% during 2024-25. Financial inclusion. Now credit deliveries, these are the points in credit delivery. Now coming to the financial inclusion. First of all, assignment of lead bank responsibility. So at present, there are 12 public sector banks and 2 private sector banks that have been provided the lead bank responsibility covering 782 districts across the country. Next is universal access to financial services in every village. So this is important, okay? This data point as well as this point you can use in your answer writing, that providing banking access. It was announced that under the the NSFI, that is the National Strategy for Financial Inclusion. So under the National Strategy for Financial Inclusion, it was said that we have to provide banking access to every village within a 5-kilometer radius or the hamlet of 500 households in hilly areas. In hilly areas particularly, this was for the hilly areas. So this was one of the milestone of the NSFI 2019-2024. So providing banking access to every village within a 5-kilometer radius or hamlet of 500 households in the hilly areas. So they have to be provided with the banking access. This has been fully achieved in 27 states and 8 union territories. So 99.99% of the identified villages or hamlets across the country have been covered, and further the remaining are also going to be covered, but 99.99% have already been covered. Next is the aggregate balance in basic service bank deposit accounts increased by 11.9%. That means the people are getting more aware about their basic savings bank deposit and they are using more of the banking services. Okay. The composite for financial inclusion index. Now this data, financial inclusion index data, is released once a year. Now it is going to be released in July because last year it released in July. So this data point you can ignore for now because in the July the next financial inclusion index will be released. But try to remember that the financial inclusion index, this is the index that covers the financial inclusion of the country in the country. Okay, and this depends upon 3 parameters, that is usage, quality, and access. Okay, so these are the 3 financial inclusion index parameters, right? These are the 3, right? Usage, quality, and access. Against the extras, just tell me if it is correct according to you. So composite financial inclusion index registered a year-on-year growth of 6.8% from 2023 to 2024, and the major contribution was from the financial inclusion usage component. So financial inclusion index, this has the 3 parameters: usage, access, and quality. Okay. Now the next one is going to released in July. Now, National Strategy for Financial Inclusion, it was released in January 2020, has facilitated the deepening of financial inclusion in the country. Coming to the financial literacy. So, observing the Financial Literacy Week 2025. So, the Financial Literacy Week, it is celebrated every year. This year, the Financial Literacy Week had the theme Financial Literacy Women's Prosperity. Activities conducted by financial literacy centers and Center for Financial Literacy. So, remember that financial literacy centers and centers for financial literacy, they are different. So centers for financial literacy, they set up in collaboration of the non-governmental organizations and sponsor banks. They are set up at a block level, and one center for financial literacy caters to about 3 blocks. Camps are conducted for individuals that are aged between 18 to 60 years. Camps are free of charge. Financial literacy centers, they are set up by lead banks of the district, conduct camps for farmers, micro entrepreneurs, self-help groups, school children, and senior citizens. So they have different target groups basically, and they are sponsored by different entities. Conduct camps on digital financial literacy, and camps are free of charge. So this is the idea. So financial literacy centers, they conducted various camps, and the Center for Financial Literacy, this was a pilot project that was launched in 2017, and now they are conducting more and more camps in the country. Okay. So the CFL project was scaled up in a phased manner, slowly, to cover up the entire country by 2024, with each CFL covering about 3 blocks. Coming to the next point, that is the Reserve Bank of India 90 quiz. So as part of the series of events to mark the 90th year of the Reserve Bank, a nationwide general knowledge based quiz competition that was conducted. So this also came under the financial literacy to check the knowledge of the people in regards to the RBI and the financial segment of our country. Now, agenda for 2025-26. Now, for 2025-26, that is for this financial year, it is said that the RBI is going to review the financial inclusion index. Okay, strengthening the micro, small, and medium enterprises outreach and inclusion, achieving 100% coverage in 80% districts across the country under the EDDPE. So, right now, 60% has been achieved. So basically right now 60% has been achieved under the EDTPE. So it is targeted that by like in this coming financial year, we are going to achieve 80%. Okay. So this is the target. 80%. So 80% districts have to be covered under the EDTP by March 2026. Now next is financial markets and foreign exchange market. Okay. So financial market regulation department. So hedging of gold price risk in overseas market. So simply see, let's say that you want to buy gold after 2 months. Let's say you want to buy gold after 2 months. Now right now the gold price is 60,000. Now you are afraid that after 2 months, maybe the gold price might reach to 1 lakh. That can happen in the case of gold. So you are afraid that what if I buy after 2 months and the gold price reach to 1 lakh or more than 1 lakh? So what you will do that you will come into a contract. This is the derivative. This is a derivative. Let's say it is a future contract. You are coming into a future contract that I want to buy gold. Let's say you want to buy gold on 30th July 2025 and you want to buy the gold at rupees 80,000. Or let's say this is the contract that is present that at 80,000 you will be able to buy the gold. So this has reduced your risk. This has reduced your risk, or you have hedged your risk, you have reduced your risk, okay? Because you were worried that what if after 2 months the price might reach to 1 lakh, more than 1 lakh, maybe it might reach to 1.5 lakh and something. So to reduce your risk, you have come into this contract. So it was said by the RBI that if you want to reduce your gold price risk, before only the exchange traded derivatives were allowed for the entities, but now even the OTC derivatives will also be allowed. Over the counter derivatives that are not traded on exchange, they will also be allowed. So as announced in the statement on developmental and regulatory policy document in February 2024, resident entities, the residents, they are permitted to hedge their exposure, to hedge their gold price risk using the OTC, over the counter derivatives in the IFC. Now OTC derivatives in the International Financial Service Center. Now India has one International Financial Service Center. Where is it? Can anyone tell me? Where is it? So OTC derivatives are also allowed for the gold, hedging the gold price risk. Next is fully accessible route for the investment by non-residents in government securities. So in April, like in consultation with the government, it was decided to exclude all the new government securities of 14-year and 30-year tenors from the fully accessible route. From this, a question came in last year RBI Grade B examination, right? Now all the sovereign, it was further said that all the sovereign green bonds of 10-year tenure, they will be included under the fully accessible route for the second half of the financial year 2024-25. Okay, so yes, the IFC is in Gujarat. Okay, so gift in the gift city. Now next is access of SEBI registered non-bank brokers to the NDSOM. Now this was in news in February 2025 and I took a session on this also, that the SEBI registered non-bank brokers like Zerodha, Angel One, Grow. So these are the non-bank brokers, Zerodha and such. No? So they will also be able to get access to the NDSOM and they will be able, like non-bank brokers, they will be able to provide the access of the NDSOM to their constituents or to their customers. NDSOM, this is a platform of the Reserve Bank of India. This is the negotiated dealing system. Order matching, this is the platform of the Reserve Bank of India through which the secondary market trade can happen in the government securities between the investors. So investors can trade the government securities among themselves in the secondary market through this NDSOM platform. And in February 2025, it was announced that SEBI registered non-bank brokers will be able to access NDSOM and will be able to provide the NDSOM platform to their constituents and consumers. Okay. Now, Financial Market Regulation Department has further done the announcement that reporting of foreign exchange cash tomorrow spot. So cash transaction is right now, we are doing the transaction and we are settling the transaction right now. Tomorrow means that the settlement of transaction will happen tomorrow. Spot means that the settlement of transaction will happen day after tomorrow. Okay. So cash means settlement will happen right now. Tomorrow means settlement will happen tomorrow. Spot means settlement will happen day after tomorrow. So reporting of foreign exchange in the cash tomorrow and spot transaction to the trade repository. So it is announced by the Reserve Bank of India that this is a centralized repository that RBI is creating, and it is mandated that all the foreign exchange cash tomorrow or spot trades have to be reported to the trade repository of CCIL. As well as it was also announced that all the transactions that are done to hedge price risk of gold, so all the transactions have to be reported in the trade repository of the CCIL. So basically a question can come that where the reporting happens, so it is in the trade repository of the CCIL. Okay. Next is government securities transactions between. See what happened, that let's say you are a primary dealer. Now primary dealers, they are present in the government securities market. They are the market makers. They buy the government securities from the sellers that want to sell it, and they can work as the sellers for the government securities for the buyers that want to buy the government securities. Okay, so the primary dealers, they work as market makers. They can maintain the liquidity in the government security. Now the primary members, so the primary dealers as well as the other primary members, if they are trading in government securities with their own gilt account holders. Now you and me, we are the retail investors that can invest in the government securities, but we cannot have we have to trade the government securities in the secondary market through the primary member. Okay, so we are connected. Let's say gilt account holders, they are connected with the primary market, with the primary member. Okay, so gilt account holders, they are connected with the primary member. Now if let's say the primary member and the gilt account holder, they are doing the trade among themselves like in the secondary market, so the NDS OM platform was not provided for them. As well as the gilt account holders, the multiple gilt account holders of a single primary member, if they were trading among themselves, the government securities, if they were trading among themselves in the secondary market, they were not allowed the access of NDS OM. So it was said by the Reserve Bank of India to bring the uniformity in the trading and settlement norms for government securities in the secondary market in the NDS through the NDS OM platform. So the facility of clearing and settlement through CCIL has been provided for the transactions between the primary member and its own gilt account holders and the gilt account holders of one primary members, or two gilt account holders of the same primary member, which are bilaterally negotiated and reported to the NDS OM platform. So now they are provided the trade that is happening between the primary member and its own gilt account holder, or the two gilt account holders of a primary member. So now these trades can also happen through the NDS OM platform, that is the platform for secondary market transactions in government securities, and these can be settled through the CCIL. So the extension has been done. Now this was in news in February 2025, that's why this is important. Next point is that Financial Market Operations Department, this primarily responsible for conducting the liquidity management operations. So this is the Financial Market Operation Department. Okay, so under the Reserve Bank's liquidity adjustment facility, you can understand that there is in the liquidity adjustment facility, there is the standing deposit facility, the repo rate, the margin standing facility rate. So under the repo rate, the RBI is giving the loans to the banks and RBI is taking the collateral from the bank. So RBI is providing loan to the banks and RBI is taking the collateral from the banks. Okay, so collateral, the RBI is taking the collateral in the form of government securities, Now see what happens, that the valuation of the various government securities collateral is done on the basis of daily market rates published by the Financial Benchmark India Private Limited. To enhance the system robustness and to bring the efficiency, it is said that an auto-updated facility has been deployed in eKuber 2.0, in which the market rates of government securities are directly fetched from the FBIL website. So on the daily basis, the RBI is taking the collaterals. So on the daily basis, the valuation of the collateral should happen. So that can happen automatically now through the eKuber 2.0. Now coming to the Foreign Exchange Department. So basically, the liberalized remittance scheme, like it is available for the liberalized remittance scheme, it is available for the resident individuals. It is only available for the resident individuals. Under the liberalized remittance scheme, the resident individuals, they can send the remittances to other countries. They can send the money to other countries for the current account and capital account transactions. Okay, for their investment purposes, for their trade purposes, for their remittance purposes. If they want to send money outside, they can send till a limit, okay, without any restriction and such. Now it was said that under the LRS to IFSC, now International Financial Service Center, that is present in Gujarat and Gift City in our country. So we have only one IFC in our country, okay. So it is said that the liberalized remittance scheme, under this, the remittances that are sent by the resident individuals, so resident individuals of India, they can send the remittances under the liberalized remittance scheme to the IFC also for availing the financial services or financial products as per the IFC's as per the IFCA, that is the International Financial Service Center Authority. So the resident individuals can send the money, can do the remittance to the IFC under the LRS for availing, for buying the financial services, financial products in the IFC, within the IFC. All the current account or capital account transactions in any, so through a foreign currency account. So simply, let's say you have sent the money to the IFC and you are keeping the foreign exchange in the foreign currency account in the IFC. Now through this foreign currency account, the foreign exchange that you have, now through this foreign currency account, you can send the money for any of the current account or capital account transaction, okay. So basically, under the liberalized remittance scheme, the money that you are sending to other countries and the rules that you are following, that same rules will be followed in the IFC also. So you can send the money to the IFC for availing the financial services, for availing the financial products, as well as you can send the money. The foreign currency, you can send the money to IFC in the foreign currency for availing the current account, capital account transactions with other countries. Next is this, again we have just discussed this in our previous class, that Reserve Bank and the Maldives Monetary Authority, they have signed a memorandum of understanding for establishing a framework to promote the use of local currency. See, the Reserve Bank of India, it is under the ACU also, it is under the Asian Clearing Union. So Reserve Bank of India, the Reserve Bank of India is part of the Asian Clearing Union, as well as the Maldives is also where is Maldives? So Maldives is also a part of the Asian Clearing Union, okay. So under the Asian Clearing Union, what happens that the transactions or the settlement of trade can happen on the net basis. That means, let's say we have traded with Maldives and Maldives have traded with us. So we have to give 5 crore rupees to, or we have to give $5 billion to Maldives. Maldives have to give for its imports, the Maldives have to give $3 billion to India. So we will only transact the net amount, that is $2 billion, okay. So RBI has to give $5 billion to Maldives, let's say, and Maldives have to give $3 billion to India for the trade that India and Maldives have done. So on the net basis, the settlement will happen, only $2 billion will be transferred. Only $2 billion will be transferred to Maldives from India, because India had to transfer higher amount. So India will transfer the rest amount. So Asian Clearing Union is a payment arrangement whereby the participants, that are these countries, they settle payments for regional transaction or the transaction that is happening between these countries among the participating central banks on a net multilateral basis. On the net basis, the transaction is done. Now, in addition to the existing ACU mechanism that is present between RBI and Maldives and the other countries, the RBI and Maldives, they also signed the MOU that they will allow the transaction in between these two countries in the local currencies, that is in the Maldivian rupiah and the Indian rupees. So Maldivian rupiah and the Indian rupees will be allowed for the cross-border transactions. So local currencies will be allowed for cross-border transaction. So this is the idea, that in addition to the existing ACU mechanism, now the local currencies are being permitted. Local currencies are being permitted for the cross-border transaction between these countries. Coming to the next chapter, the Financial Stability Department. So regulation, supervision and financial stability. So Financial Stability Department, this is the department that monitors the risk in the country, in the macroeconomic situation of the country. So Financial Stability Department monitors the risk to macro financial stability and evaluates the resilience of the financial system. Now the Financial Stability Department is also, it also functions as the secretariat to the subcommittee of the Financial Stability and Development Council. Who is the head of this subcommittee? Anyone can tell me? Who is the head of subcommittee of FSDC? It is the RBI governor, right? So the FSD, that is the Financial Stability Department, it functions as the secretariat of the subcommittee of the FSDC, as well as this department prepares the financial stability report. Okay, this is the idea. Yes. Now, regulation of financial intermediaries. Regulation of financial intermediaries. So, Department of Regulation is the nodal department for regulation. Okay. So, Department of Regulation, this is the nodal department for regulation of commercial banks or regulating the regulated entities. So, basically, the Department of Regulation regulates the regulated entities. Now, it has released certain rules. So, first of all, the Department of Regulation has created the Reserve Bank Climate Risk Information System. Now, if you remember that like a few months back, we discussed that RBI recognized that the regulated entities, they are not able to do the climate risk assessment because they do not have the climate risk data available. That's why the Reserve Bank of India created this climate risk information system. Under this system, what will happen that this is the data repository. So under this system, the data will be compiled and the data will be kept. Okay. So in October 2024, the Reserve Bank announced the creation of the Reserve Bank Climate Risk Information System, that will be data repository, so that the regulated entities can get the climate related data from this repository, and the regulated entities can use this data for the assessment. Okay. So the Reserve Bank created this repository to bridge the data related gaps for undertaking the climate risk assessment by the regulated entities. Okay. So that the regulated entities can take the climate risk assessment, can do the climate risk assessment. Now, exposure of scheduled commercial banks to NBFCs. So if you remember that in 2023, the risk weight were increased. So in 2023, the risk weight were increased for the loans that were being provided by the scheduled commercial bank to NBFCs, because there was too much loan that was getting provided from the scheduled commercial bank to NBFCs. So the Reserve Bank of India increased the risk weight for the loans that are getting provided by the scheduled commercial bank to NBFCs. Now, recently in February 2025, it is said that the risk weight will be decreased to the previous level. Okay. So, on a review in February, it is said it was decided by the Reserve Bank of India to restore the risk weight to the previous level for the exposure of the scheduled commercial bank to NBFCs for the loans that the scheduled commercial banks are providing to the NBFCs. With the given external, on the basis of the given external rating. So risk weight will now again be decided on the basis of the given external rating of NBFCs, where the existing risk weight as per external rating of NBFCs is below 100%. So if the risk weight is below 100%, so the external rating will be followed. So this we have discussed in Finance 360-degree session also. So there was too much loan that the scheduled commercial bank were providing to the NBFCs. So the risk weight was increased by the RBI in 2023. Now in 2025, it is decided that we are going to move back to the previous risk weight. That is the risk weight that is decided by the external, by the external rating done by the credit rating agencies, where the existing risk weight as per external rating of NBFCs is below 100%. Okay. Now, next is the digital lending. So here you can see that Reserve Bank has issued the instructions. Now, how many of you have seen the digital lending regulations that the session I have taken recently? So this is related to that session. Okay. So digital lending guidelines are released, and that are very important that you have to see. Okay. So Reserve Bank has issued instructions regarding operationalization of the public directory of the digital lending apps. So digital lending apps, it is said by the Reserve Bank of India, that RBI is maintaining, or RBI is creating a digital lending app repository where all the regulated entities have to inform about the digital lending apps that are connected with the regulated entities, and this has to be informed in the CIMS portal of the Reserve Bank of India. Okay, so this is the basic idea that all the regulated entities, they have to report the details of their digital lending apps through the CIMS, through the Centralized Information Management System, to the Reserve Bank of India and the regulated entities. This depository will be there for the digital lending app, so that everyone can know that which digital lending app is connected with which regulated entity. Okay, next is your submission of information to credit information companies by asset reconstruction companies. Okay, so all the asset reconstruction companies, they were advised to become member of all the credit information companies. Okay, so basically it was said that the asset reconstruction companies, they should give fortnightly data to the credit information companies, and in case the credit information companies have found that the data, there is some problem in the data, so rectification of the rejected data has to happen within 7 days of receipt of the rejected data. Next is that voluntary transition. The small finance banks can voluntarily transition into universal banks if the small finance banks, they have the minimum net worth of rupees 1000 crores. If they have the CRAR of 15%, that is the capital to risk weighted asset ratio of 15%. If they have the net profits in the preceding 2 financial years, and their gross non-performing asset and the net non-performing asset is less than, like gross non-performing asset is less than 3%, less than or equal to 3%, and the net non-performing asset is less than or equal to, it is less than or equal to 1%. Okay. Next is the guidelines on settlement of dues of borrowers by asset reconstruction companies. So here basically what happened, that the asset reconstruction companies have bought a bad loan. Now the asset reconstruction company thinks that, okay, there is no way to get back the money. Okay, so asset reconstruction companies, they buy the bad loans, they buy the non-performing asset of the banks or NBFCs. Now if the asset reconstruction companies feel that they do not have any other way to like get back the money, to get back the loans, so they can do the settlement with the borrowers. Now it is said that settlement should be done with the borrower after all the other possible ways to recover the money has been seen, and there are no other way to recover the money. There is only one way, that is to settle with the borrower. Then the settlement can happen. In case the settlement of accounts, they have aggregate outstanding value of more than 1 crore. In this case, all the accounts. So in case the settlement amount is more than 1 crore, or in the case where the borrower is a willful defaulter or is a fraud case, in this case first the proposal of settlement has to be examined by the independent advisory committee, followed by a review by the board of directors. So in case the settlement amount is of more than 1 crore, settlement of accounts having aggregate outstanding value of more than 1 crore. That means if the loan value that is outstanding is more than 1 crore, not the settlement amount, but the outstanding value, aggregate outstanding value is more than 1 crore, or in the case where the borrower is a fraudster, fraud category, or willful defaulter, in that case first the proposal has to be examined for the settlement by the independent advisory committee, followed by the review from the board of directors. In case the settlement is of the settlement and the board of directors, that should comprise of at least 2 independent directors. Okay. Now settlement of accounts having aggregate outstanding value of less than 1 crore. So if the outstanding value of the loan is less than 1 crore, in that case there is no need for independent advisory committee or the review by the board of directors with independent directors. There is no such need. But in the case the settlement is happening of the outstanding value of less than 1 crore, it shall be done as per the board approved policy. Okay, this is the idea. Now next is review and rationalization of prudential norms. How many of you remember studying this? This was released in February, I guess. So if you remember that here, the small value loans, their limit was changed. Okay, so I'm not going to discuss this whole because this is a very big article and you have to see the complete session on this, okay, in the Finance 360. So it is, I think it is in Finance 360 degree February session. And see, if you do not have to see, you do not have the time to see each and every session, then at least go and see the monthly revision session of the RBI notification and RBI press releases for the February month. Okay, so this will be covered, as well as review of risk weight on microfinance loans. So as the review happened of risk weight for the NBFCs, the review of risk weight on microfinance loans was also done. So this is also a February news article that you can see in the monthly revision session of February. Now next is fintech department. Now coming to the fintech department, that has the responsibility of fostering innovation in the fintech ecosystem. So the fintech department is the one that is further bringing the use cases in the CBDC. So central bank digital currency, it has got new use cases, it has got new functionalities, that is the offline. So the Reserve Bank, the fintech department has since rolled out multiple pilots, multiple new functionalities such as the offline system for the CBDC as well as the programmability. In the programmability, basically this CBDC can be used for specific reasons and specific purposes. Let's say the RBI wants to give subsidy for the fertilizers to the farmers. So government, not RBI, the government wants to give subsidy, the government of India wants to give subsidy to the farmers for the fertilizers. So under the CBDC, there is a function of programmability in which the CBDC can be used for the specific purpose at the specific places only. So if the government is releasing the subsidy for the fertilizers, now this money, this subsidy can only be used in the shops that are particularly for the fertilizers. So this is the programmability feature, so that the CBDC can be used in a specific manner and the government will be able to release the subsidies for the particular things that can be used only in the particular shops for the specific reasons. Okay, so these are the new features. So programmability use cases include direct benefit transfer to the farmers against generation of carbon credits. So it can be used for various reasons. Okay, so programmability, under this, the RBI, the government can use it for the release of subsidies or release of direct benefit transfer. Next is fintech repository. This was launched on May 28, 2024 to capture the essential information about the fintech entities. As well as with the fintech repository, there was the MTech repository that was also later on launched. The MTech repository, it is for the regulated entities, and this repository, this captures the information on the adoption and usage of the new technologies by the regulated entities such as banks, NBFCs, and the other regulated entities under the Reserve Bank of India. Next is the Reserve Bank launched the third edition of its annual Global Hackathon Harbinger 2024, Innovation and Transformation, focusing on two themes: zero financial frauds and being Divyang friendly. So these were the two themes of the Harbinger 2024 that was launched in June 2024. Major initiatives under the fintech department, the major initiative is the framework for responsible and ethical enablement of AI. So basically the fintech department is saying that we need a framework for responsible and ethical use of the AI. So for this, there was a expert committee that was established. So Reserve Bank constituted an external committee, expert committee for the free AI, that is framework for responsible and ethical enablement of AI. Next is global conference was conducted on digital public infrastructure and emerging technologies under the celebrations of 90th year of Reserve Bank of India. Now these are some terminologies that were present in the annual report. So at least you should know about the terminologies, the basic idea of terminologies. Okay. So FinQuery, this is an initiative that provides the opportunity for the fintech companies to connect with the fintech department. Okay. So FinQuery, this provides an opportunity for the fintech companies to visit the fintech department. Okay, FinTract is conducted across various cities to interact with the public. Next is, or to interact with the fintech companies also. The Reserve Bank also launched an initiative named FinConnect. In the FinConnect, what happens? See, there is the regulatory sandbox. Under the regulatory sandbox, there are certain entities whose innovations are accepted. That okay, these innovations, they can be made public later on. Okay. Under the Harbinger also, under the Harbinger, it is said that these are the problem statements and the entities, they can develop solution. Now the solution that has been developed under the regulatory sandbox, there are certain solutions that have been developed. Under the Harbinger also, there are certain solutions that have been developed. Okay. So FinConnect, this is aimed at providing a platform to connect successful entities from the regulatory sandbox and the Harbinger with the potential users of such solutions, such as the banks, NBFCs, separately with the investors and such. So FinConnect is providing the opportunities to the regulatory sandbox and the Harbinger entities that have successfully created some new solution, okay, to connect with the investors, to connect with the banks and NBFCs and such. Now RBI also have the Reserve Bank of Innovation Hub initiative was to launch the Mule Hunter AI. So this is very important. This we have discussed also. Next is the supervision of financial intermediaries. Okay, so Department of Supervision, this supervises the different entities. Okay, so Department of Regulation make the regulations. Department of Supervision supervises the different entities. So in assessment, so the fraud, so number of bank frauds, so that we will discuss now. Okay, so an assessment of bank group wise fraud cases over the last years was done, and the largest number of frauds has happened under the private sector banks. Largest amount of frauds have happened maximum under the public sector banks. Okay, so the amount involved in the frauds was maximum under the public sector banks. So an assessment of bank group wise fraud cases over the last 3 years indicates that while private sector banks have reported maximum number of frauds, the public sector banks have continued to contribute maximum to the fraud amount. Okay, and in the case like from where the frauds are coming or from where, in which category the frauds are maximum, so frauds have predominantly occurred in the category of digital payments, card or internet. So the number of frauds are highest in the card and internet, but the amount of fraud is highest in the category of loan portfolio. So frauds have occurred predominantly in the category of digital payments in terms of number of frauds, and primarily in the loan portfolio in terms of value of loans. Okay, while card or internet frauds contributed maximum to the number of frauds reported by private sector banks, the frauds in public sector banks were mainly in loan portfolio, because public sector banks recorded or they notified the largest amount of frauds. Okay, so that was in loan portfolio. Next is for Department of Supervision. They have said the Department of Supervision has included the upper layer NBFCs and those within asset size of over 5,000 crores in the middle layer are now covered under the risk-based approach for KYC or anti-money laundering. Okay, so these NBFCs, they have to be more prudent. They have to be more prudent in terms of KYC and anti-money laundering rules. Similarly, the urban cooperative banks, that are the big urban cooperative banks, that are the tier 3 and tier 4 urban cooperative banks, they are also included under the risk-based approach for KYC or anti-money laundering. So they have to be more prudent in case of the KYC and anti-money laundering. Okay, fraud monitoring, returns and return on theft, burglary, dacoity, robbery. So commercial banks excluding RRBs, NBFCs excluding HFCs in the upper layer, middle layer and base layer with asset size of 500 crores and above, and urban cooperative banks, they are all required to report such kind of incidents on the CIMS portal. Okay, next is Consumer Education and Protection Department. You know that the Consumer Education and Protection Department is the one that administers the Reserve Bank Integrated Ombudsman Scheme, as well as it also oversees the performance of the Consumer Education and Protection cells. So see, the receipt of complaints at the offices of Reserve Bank of India Ombudsman. So under the Reserve Bank of India Ombudsman offices, there were 2.96 lakh complaints that were received in the 2024-25, as well as the complaints were mainly received against the banks, followed by NBFCs, and then the non-bank system participants and credit information companies. Majority of the complaints have came against the loan or advances category, and after that digital banking products. So this is as per the annual report that was released for the integrated ombudsman report. Okay, now next is awareness initiatives. So the Consumer Education and Protection Department has taken various awareness initiatives that you can see. The awareness booklet has been released, animated short films are being developed and such. Next is the DICGC. Now, as on September 30, 2024, the number of fully insured deposit accounts under the coverage limit of 5 lakh was 97.7%. So most of the accounts are covered fully under this, like they are covered fully under this under the DICGC. While this is in the terms of number, total number of accounts, but when we see in the terms of value, the deposits are insured to 42.6%, because in some amount, in some accounts there are crores of money, right? So only 42.6% of the value is insured by DICGC. So that is 97.7% of the deposit accounts are fully insured, and 42.6% of the amount or value is insured by DICGC. Now coming to the public debt management. So here the Reserve Bank has successfully completed the gross combined. So Reserve Bank of India is the entity that issues the government securities on behalf of the central government, and that do the borrowing for the central and state government. So Reserve Bank of India do the borrowing for the state and central governments. Okay, so Reserve Bank of India has successfully completed the combined gross market borrowings of the central and state government, but it is lower by 3% as compared to the previous year. During 2024-25, the securities ranging from 3-year to 50-year tenure, they were issued as part of the government's market borrowing program. So major focus was given to 3-year to 50-year government securities, the dated securities, that are the long-term securities. Next, debt management. So during 2024-25, both the gross and net market borrowings of the government of India has decreased. Okay, were lower by 9.2. So gross borrowings, first of all, gross borrowings are the total borrowings of the central government. These borrowings are done for doing the expenditure as well as repaying the earlier loans, While the net borrowings, these are the borrowings that are taken for the expenditure of the government. So in the gross borrowings, we are including the borrowings for the expenditure as well as the borrowings that are done for repaying the earlier loans. In the net borrowings, we only take the borrowings for the expenditure. So the net borrowings and gross borrowings, they were both lower for the government of India. Percentages not very important. Now, commercial banks remain the largest holder of the government securities. After that, there was insurance companies. After that, provident funds, and then the Reserve Bank. Okay, so the largest holders of the government securities are the commercial banks. Next, the number of primary dealers stood at 21, 14 bank as primary dealers, 7 standalone primary dealers. Next, based on market feedback, see, there is the benchmark, there is the benchmark interest rate. There is the benchmark interest rate, that is repo rate, according to which the interest rate fluctuates in the country, according to which the interest rate is determined in the country. Similarly, there is the benchmark security, according to which the returns, benchmark security has certain returns. So according to the returns or the profit or the interest in this benchmark security, the interest fluctuates the returns fluctuate for the other securities. Okay, so there is the benchmark security. So there is the benchmark security, according to which the fluctuations that are coming in the returns of this benchmark security. So in the same manner, the fluctuation can come in the returns of the other securities. So based on the market feedback and in line with global market practices, issuance of benchmark security in 15-year tenure was introduced during the year in place of 14-year benchmark security. So before the 14-year tenure of the government security was the benchmark security. Now 15-year tenure of the security is considered as the benchmark security. Okay. Now the share of market borrowings in financing the gross fiscal deficit. So basically the states, they did 79%. They did 79% of the borrowing for financing their gross fiscal deficit. Okay. So the share of market borrowing that was done by the states, it was 79% for financing the gross fiscal deficit, for financing their fiscal deficit. Okay. Now the retail direct scheme through which retail investors can engage in the government securities, or they can buy the government securities. So retail direct portal, to further expand the modes of payment available in the retail direct portal, mobile or their mobile application. So now the retail direct scheme has also the mobile application. So UPI single block and single debit facility has been introduced, in which in this facility in the UPI the amount can be blocked for the government security, for purchasing the government security in the primary auction, and this is the idea. Okay, so UPI single block and single debt facility, in this the amount can be blocked for the bidding for the primary auctions. This is the idea. Next is currency management. So Reserve Bank is no longer printing the banknotes of denomination 25 and 2000. The value and volume of banknotes in circulation have increased by 6% and 5.6%. During the 2024-25, the highest volume and highest value of the banknotes that were present was of 500 rupees, and after that followed by rupees 10. The lower denomination banknotes together constituted 31.17% of the total banknotes. E-rupee circulation has increased by 334%. implementations. Now see, the RBI is majorly focusing on modernizing the currency management architecture. So RBI is focusing on modernizing the currency management architecture. For that, the RBI has started the project Samudra. So here the RBI is redesigning and modernizing the currency management architecture in the country to modernize the currency management architecture, basically. Disposal of soiled banknotes. So the disposal of soiled banknotes increased by 12.3% in the financial year 2024-25. The counterfeit notes detected were mostly in the 200 and 500 denominations. So most of the counterfeit notes were detected in 200 and 500 denominations. Okay. Next is the highest share of currency chest is under State Bank of India. So State Bank of India accounted for the highest share of currency chest. Currency chest is like where the currency is stored and from where the currency is sent to other banks and other bank branches that do not have the currency chest. Okay. So the highest share of currency chest is under the State Bank of India. Coming to the payment and settlement system and information technology, I guess this is the 9th and last 2 chapters. Okay. India's payment and settlement system recorded a robust growth of 34.8% in terms of transaction, and in value terms, the growth was 17.3% in the payment and settlement system. Okay. Now, this was basically mainly due to the growth in large value payment system, that is RTGS. So the payment and settlement system have recorded a robust growth of 34.8% in terms of transaction volume and 17.3% in terms of value. Okay. The success of UPI. Now the next point is that the success of UPI placed India in a leadership position with a share of 48.5% in global real-time payments by volume. So nearly half of the real-time payments volume share is of India at the global level. This is the success of UPI placed India in a leadership position, in the top position, with a share of 48.5% in global real-time payments by volume. Okay. Next is that during 2024-25 RTGS, now large value payment system has helped in the growth of the value of transaction. So in terms of the growth, in the value terms, the growth was 17.3% in 2024-25. This is due to the growth in the RTGS. This is due to the growth in the large payment system. Okay. Now RTGS transactions increased by 12% in volume and 17.8% in value terms. Now see, this is the system through which the transactions happen. So the large value transactions are the RTGS. The large value transactions, it happens through the RTGS. Now the retail segment, under the retail segment, the transactions are happening through these. So under the retail segment, the transactions are happening from, under the retail payments, the transactions come from 2 to 6. That is for like transfer through the UPI, NEFT, IMPS, the Bhim Aadhaar Pay and such. So even paper-based instruments through that also. So these are the retail payments. Now digital payments, in the digital payments, it comes from 1 to 5. These are the digital payments. So remember, the large value transactions can happen through the RTGS. The retail transactions are through the other means, and the digital transactions do not consist of the paper-based instrument. This is to show you the idea. So RTGS transactions are taken separately from the retail transactions, basically because in the retail transactions, the RTGS transaction do not come. In the retail transactions from 2 to 6 that come. Next is the PIDF. PIDF is the Payment Infrastructure Development Fund that provides the subsidies for the QR codes and for the POS machines. Okay. So the PIDF, it aids the growth in the digital payment during the year by subsidizing the availability of the acceptance infrastructure. It subsidizes the POS machines and the QR codes. Now, during the 2024-25, the number of point of sale terminals have increased by 24.7%, while the QR codes have increased by 91.5%. So that is a very big thing. Okay. Next is, during the year, the Department of Payment and Settlement System launched many initiatives. Okay. In line to the Payment Vision 2025. So Payment Vision 2025 has 5 I's: integrity, inclusion, innovation, institutionalization, and internalization. Okay, internationalization. So these are the 5 I's in the Payment Vision 2025. So DPSS has launched various initiatives. Introduction of delegated payments through UPI. This is called UPI circle that we have again and again discussed. through which you can delegate the payments to the secondary users. Business to business payment can be done through the Bharat Bill payment system now. UPI limits have been enhanced for UPI 123 Pay, for UPI Lite, and for the tax payments through the UPI. Okay, so the limits you can see. Enhancing public awareness through various channels. So there are various e-Baat programs that are being conducted. So that is electronic banking awareness and training programs are being conducted. Okay, auto replenishment of FASTag, national common mobility card, and the UPI Lite. So in these systems, what is happening that if, let's say, in FASTag you want to have rupees 500, now if, or rupees 200, if the value is going below rupees 200, so now it will be auto replenished. So if the balance goes below a threshold amount set by the customer, the FASTag can be auto replenished. So this is the auto replenishment facility that has been introduced. UPI for cash deposit. So for taking out the money from the ATMs, you can also scan the QR code, and like UPI can be used for taking out the cash from the ATM. So now UPI can be used for the cash deposit also. Next is internationalization. So this was regarding the inclusion and innovation. Now coming to the internationalization. So the Reserve Bank of India and the Department of Payment and Settlement System, they are like doing the global outreach. So there is the global outreach of UPI and RuPay credit cards, RuPay cards as one of the key objectives. So Payment Vision 2025 document, it had the main objective of global outreach of UPI and RuPay cards. Acceptance of India's UPI apps via QR code has been operationalized in various countries: Bhutan, France, Mauritius, Nepal, Singapore. RuPay cards acceptance is presently live in Nepal, Bhutan, Mauritius, Singapore, as well as in certain countries. There is also the issuance of the RuPay cards that has started in Bhutan and Mauritius particularly. Next is Department of Information Technology. So Department of Information Technology has developed Prava, that is the platform for the external purposes, for taking the applications, for taking for like the regulated entities, if they want to provide the application to the Reserve Bank of India, if they want to take validation from the Reserve Bank of India, if they want to take the authorization from the Reserve Bank of India, the regulated entities can do it through the Prava portal. Sarthi portal is for the internal processes of the Reserve Bank of India. Okay. Now, department has prioritized the in-house development of eKuber 3.0, that is the core banking system of the Reserve Bank of India. The Department of Information Technology is also developing the alternate messaging system and alternate mechanism for digital payment system in the country itself, by itself. Okay. Now, 6-month-long cyber security awareness drive was also launched with the theme Cyber Surakshit Bharat. Okay. Next is to enable. Now, see, there is a very important system that is required. See, when the transaction has to happen between two banks, there is the communication that is required, or there is the financial messaging system that is required. Now, at the global level, when the transactions are happening, so there is the requirement of a messaging system between the entities. So, RBI has developed, or the Department of Information Technology of RBI has developed the structured financial messaging system of India that can be used at the global level, so that the cross-border transactions can happen in rupees. Yes, at the global level, there is SWIFT, right? That is used by the countries all over the world. So now India is developing its own messaging system. So that is quite good. So to enable cross-border payments in local currencies, the Reserve Bank has completed the development of global structured financial messaging system hub during the year. Using the services of this hub, interested countries through the central bank or designated bank may directly send or receive financial messages to or from the designated bank in India. So this is the structured financial messaging system developed in India by RBI. Kuber 3.0, so as it is said that the Department of Information Technology in-house is developing the eKuber 3.0, that's the core banking system of Reserve Bank of India. Next is Infinet. So Reserve Bank had initiated Infinet 3.0 project through IFTAS, that is a fully owned subsidiary of the Reserve Bank of India. Now, Infinet is a communication backbone in the Indian banking system, and Infinet consists of the members such as the Reserve Bank of India, member banks, and financial institutions. So it is for the closed user group, for only the members, okay, so that the communication can happen between these entities very smoothly. Next is the Prava portal that has been developed by the DIT as well as Chirag. this is a generative conversational AI tool that is being developed by the Reserve Bank of India, Sarthi 2.0. So Sarthi is for the internal processes to further like boost the internal processes efficiency and to boost the efficiency and to boost the robustness of the internal processes. Sarthi 2.0 is being developed with better user experience, with better user interface, with better responsiveness, knowledge repository functionality and integration with Microsoft Office. Okay. Next is communication, international relations, research and statistics. So RBI Museum microsite has been developed for communicating about the history of RBI and about the history of notes, about the history of the different things. Okay. Now RBI Sunta Hai, this project is currently being developed to enhance the Reserve Bank's ability to capture cues from the media. See what happens that recently, take the example of IndusInd Bank. Now the IndusInd Bank, there was a accounting discrepancy that was found. Now many of the platforms, they started saying that IndusInd Bank will fail. It's going to close down. So depositors started to panic. So seeing this, that okay, in the media, there is the problematic narrative that is going on that IndusInd Bank might fail. So Reserve Bank of India released a press release. Reserve Bank of India said that IndusInd Bank has very healthy balance sheet, it has a very healthy capital to reserve capital adequacy ratio, and the IndusInd Bank has very good financials. So there is no need to worry for the depositors. So this is the idea that RBI Sunta Hai. It is the project that is currently being developed to enhance the Reserve Bank's ability to capture cues from the media channels, which can act as early warning signal so that the RBI can release the required statements, and RBI can see that what is the narrative that is going on, what is the idea that the media channels are promoting. So it can help RBI to have the early warning signal as well as provide input for issuing clarification by the RBI that okay, RBI is saying this and not that. Okay, so this is RBI Sunta Hai. And tracking and removal. So RBI Sunta Hai, under this, the RBI will track and remove the fake news, paving the way for selective conversation. Now Reserve Bank has the RBI Kehta Hai. Through the RBI Kehta Hai, there are various campaigns that the RBI runs to create awareness about the Reserve Bank's initiative, people against the fraudulent activities. So through the RBI Kehta Hai, RBI launches various initiatives, or RBI creates awareness about the various initiatives. So through this, RBI create awareness of the RBI's initiatives and alert people about the fraudulent activities. And see, instead of now, RBI has said that instead of using the celebrities, the RBI is using the mascots, Mani Kumar and Miss Money. Okay, a question came in the previous RBI Grade B examination about these mascots also. This is under the RBI Kehta Hai. Okay. Now awareness campaigns for children, catch them young. So RBI Kehta Hai for like smart bano, cool raho. So new mascots are there. The Junior Money and the Mini Money. These were introduced for child-focused messaging, so that the children are also using mobile phones. So they should be like aware about the frauds and such. So Reserve Bank completed its tenure of chairmanship of the Southeast Asian Central Bank's research and training. Now the Bank of Korea has assumed the chairmanship. Now next is Shark Finance. So this is the network. This is the network of central bank governors and finance secretaries of the South Asian Association for Regional Cooperation, and RBI has created a roadmap for the regional cooperation for the period of 2025-2030. Enumerating the 3 focus area of cooperation within the Shark central members. Now, in the Shark, there is Pakistan, so I don't think that much of the cooperation will happen, but at least RBI has created a roadmap. Next is to encourage internationalization of the Indian rupees, to encourage internationalization of Indian rupees for bringing efficiency in trade settlement through local currency. The Reserve Bank coordinated with partner countries to enter into local currency settlement arrangements. So the Central Bank of the MOUs have been signed with Central Bank of UAE, Bank of Indonesia, Maldives Monetary Authority and Bank of Mauritius for internationalization of rupee. RBI Data App, through this RBI Data App, this is a mobile application that has been developed to provide user-friendly access to key macroeconomic financial data. So you can see various important data through this RBI Data App. Okay. Next, human resources and organizational management, just basic idea you can see, but I didn't find much important points here. Now coming to the last point, that is the Reserve Bank's accounts for 2024-25. So this is the last part. We have only one slide left. Okay, I will finish it in 5 minutes. The size of the Reserve Bank's balance sheet. So the size of Reserve Bank balance sheet as on March 31st, 2025 increased by 8.2% year on year, while income for the year increased by 22.7%. expenditure increased by 7.7%. So see, income increased by a greater percentage by 22.77% and expenditure increased by only 7.76%. Now these percentages you don't have to remember. So expenditure increased by 7.76%. So basically income increased by 22%, 22 or 23% we can say. The expenditure increased by nearly 7.76%. Okay, so income increased more as compared to expenditure, and that's why there was a huge surplus that was transferred by the RBI to the government of India. So the surplus transfer of 2,68,590 crores, this much surplus was transferred to the government of India as against 2.1 lakh crores of the previous year. Okay, now only important data here is the balance sheet has increased in size by 8.2%. Now this is the balance sheet. So this is the expenditure, sorry, this is the income of the Reserve Bank of India, that is 3,38,308 crores. This is the expenditure of the Reserve Bank of India, that is 69,714 crores. So the income minus expenditure, the income minus expenditure is your surplus, okay, available balance with the Reserve Bank of India. This was 2,68,594 crores. From this, 1 lakh has to be given to the different funds. So 1 lakh each is given to the 4 funds, and then the RBI was left with 2,68,590 crores as the surplus, which was transferred to the government of India. Okay, so basically the size of the balance sheet as on March 2025, this was 76,025. Sorry, it was 76 lakh. Sorry, it was 76 lakh 25,421 crores. So the size of balance sheet as on March 2025 was 76 lakh 25,000 crores. Income 3,38,000 crores. Expenditure 69,714 crores. So the available balance was this much, from which 2,68,500 crores was transferred. So that is 2.7 or 2.69 crores, lakh crores. 2.69 lakh crores was transferred as surplus from the Reserve Bank of India to Government of India. Okay. Now the ECF, that is the Economic Capital Framework. How many of you have seen the previous session? I hope all of you have seen the previous session. So there is the revision that has happened in the Economic Capital Framework. I have taken a complete session on that. Just in the last week, I think I have taken a session on the revision on Economic Capital Framework. So I'm not going to repeat. Just the basic idea is that in the revision of the Economic Capital Framework, the contingent risk buffer range has been made from 4.5% to 7.5%. Now the RBI has decided, the Central Board of the Reserve Bank of India has decided to maintain the contingent risk buffer at 7.5% of the balance sheet for the financial year 2024-25. So contingent risk buffer that the Central Board has approved for 2024-25 is 7.5%. Okay. Now the size of the balance sheet has increased by 8.2% year on year. So this is the idea. Okay. Basically, you don't have to remember the income or the expenditure of the Reserve Bank of India. Just remember that 2.69 lakh crore of surplus transfer has been done by the Reserve Bank of India to the Government of India. That is 2,68,590. Okay, 590 crores of the surplus transfer. The ECF range, under the revised Economic Capital Framework, the contingent risk buffer has the range of 4.5% to 7.5%. So RBI has to maintain the contingent risk buffer. The RBI has to maintain some buffers with itself. So RBI, the Central Board of RBI has said that RBI will be maintaining 7.5. The RBI will be maintaining 7.5% of balance sheet as the contingent risk buffer. Okay, this is the idea. Now, increase on the assets. So in the balance sheet, the increase on the asset size was due to the rise in price of gold. Domestic investments and foreign investments have gained. Okay. On liability side, the expansion was due to increase in notes issued, revaluation accounts. The more money was given in the revaluation accounts and other liabilities. Okay. So this is the idea. So the surplus transfer has been done by the Reserve Bank of India to the Government of India worth 2.69 lakh crore, and under the Economic Capital Framework, contingent risk buffer has been maintained by the Reserve Bank of India at 7.5% in 2024-25. So this is the buffers that the RBI has maintaining. After maintaining the enough of the buffers, the RBI has transferred the surplus. And this is 7.5% of balance sheet. Okay, this is the idea. So this is it. I hope this was good. Like, I have given a lot of efforts in this session. So I was like, just as soon as the report came, I was giving like from morning till evening, I was reading the report and I was like breaking down the report. You can like see that my throat is not well. But I thought that you need a comprehensive session. I didn't want to break it in different sessions just for like covering it up, because if I break it in different sessions, then you will have to find the different sessions and you will lose the motivation of reading and studying. Okay, that's why I brought everything in one session, so that you have the motivation that, okay, I have to complete this. And this is it. Now do tell me if you want a MCQ session on the annual report, where we will discuss the important points that you need to remember from the annual report. So if you need the MCQ session, you can tell me in the comment section below. Thank you everyone. Thank you for joining. Okay, do tell me in the comment section below if you like the session, and do tell me if the MCQ session is required for the annual report, or you will just be able to extract the information. Thank you so much. Thank you for joining. Do tell me in the comment section below if you like the session. Okay. Thank you everyone. Thank you for joining. You will get the PDF from the Telegram channel of EduTap. Okay. Yes, descriptive sessions will come. If you want the MCQ session, that you can tell in the comment section below. So in the comment section below, do tell me if you want a MCQ session on the annual report of the Reserve Bank of India. If you require it, then only I will bring it. And do comment down below, because I have given a lot of effort for this. I do not say usually that comment comment down below, but do comment down below of this video that if you have liked the session, because it will be a real good motivation for me and the team. And